Namaste, Namaskara, Vanakkam. If you think income tax is so vast, how will I revise my whole income tax in just a limited time which I have available on my hand for the coming attempt? I want to revise income tax multiple times in a short period of time. How to do that? Then guys, this marathon video is going to be a game changer in your income tax preparation. In just a very limited time, I have covered every chapter. I have not even left a single topic, guys. Every topic is covered in this marathon video, and this marathon video is equally applicable for both CA Inter and CMA Inter students. This income tax marathon, if you are a CA Inter student, it is equally applicable for May 26, September 26 and Jan 2027 attempt. And if you are a CMA Inter student, you can refer for June 26 and December 26 examinations. Guys, mind you, this marathon video I am doing it in two parts, part 1 and part 2. Part 1 itself, if you properly cover, guys, 40 marks laddu in your pocket out of 50 marks. Part 1 itself will give you 40 marks, guys. Trust me, if you do this marathon properly with a lot of patience, 3 times you do it, guys, properly. 2 to 3 times if you do it properly, income tax headache will just go off like this. In the latest attempt results, lot of students have cleared through the income tax content which I provided in the last attempt, guys. So in part 1, I will be providing basic concepts: residential status, house property, PGBP, capital gain, TDS, TCS, set off and carry forward of losses, salary, written off income. All these are covered in part 1, and the rest of topics, IFOS, clubbing, advanced tax, deductions, are covered from part 2. So do it very, very diligently. With the proper patience and hard work you have to put in, guys. Just by doing marathon, you cannot expect that you will clear your examination. But if you are looking for one Brahmastra through which you want to cover income tax multiple times in short period of time, in that case, this is going to be helpful. But if you do not have conceptual clarity, you have to go for either regular course or a practice batch, guys. This marathon video is just to revise the concepts. Here, if you are a fresh student, this video is not applicable to you. The book which I have used in this marathon video is actually Thalaiva Notes, which I have used. Thalaiva question bank is also available. If you want, you can download that also. And Thalaiva handwritten notes also I have used at multiple places. If you want to download Thalaiva Notes, Thalaiva question bank, you can just go to my website www.taxthalaiva.com. Here on this website, you will find under books, if you go, or under free resources, if you go, you'll find the free PDF, or if you go under books, this hard copy book you can place order and it will be delivered at your doorstep. Now coming to the Thalaiva handwritten notes, guys, these are the handwritten notes which I used in my regular course recently, which I recorded. If you want a beautiful summary of with a lot of examples of the whole income tax syllabus, this Thalaiva handwritten notes, you can actually buy it from the website itself. So you can refer www.taxthalaiva.com for that. And if you want a combo income tax and GST, or you want accounts, law, like that group 1 full all subjects you want, or you want group 2 also, like this you want combos, in that case you can definitely visit www.caclassroom.com, owned by Mr. Karthik Manikonda sir. So we have officially collaborated. If you want to purchase group 1, group 2 or income tax GST combo like that, you have multiple options, like Amit Mahajan sir is there, then Lijil Lakshman sir is there, like this many options are there. You can definitely create a combo and purchase from them. That's all, guys. Enjoy the marathon. All the very best. And I am damn sure from the work which I have put in, guys, you just watch the marathon, you will get the confidence. So you go, enjoy the marathon, and all the very best for your examination. This is not just the content which is coming for your examination. Lot of amazing content is awaiting and it is there in the pipeline. You will be seeing all that content in very soon before your examination. All the very best. Namaste, Namaskar, Vanakkam. Enjoy the marathon. Return of income is one of the most important chapters in your CA intermediate income tax paper. Why I say this is because almost every attempt, one 4-mark theory question is 100% asked in all the attempts. At the last end of the last question which you get in your income tax paper is from return of income, and you would have a choice also here. So this chapter becomes very, very important. I will take you through all the concepts of return of income chapter. Okay, so first thing is mandatory filing of return of income. First of all, what is a return of income? Return of income is a paper, is a statement nowadays everything is online actually. So you put all the details of your total income, under which head how much you earn income, then you will put all the gross total income, then you will take all the chapter 60 reductions, total income, what is your tax liability, everything, all the details will be provided in a particular form called as income tax return. This income tax return has a different forms, ITR 1, ITR 2, ITR 3, like this. Depending on which ITR is applicable, income tax return is applicable to you, you have to fill the details in that particular return and you have to file it with the government and you have to pay tax also. So income tax return is nothing but, return of income is nothing but a form in which you put all the details of the income which you earned during a previous year and you show what are the deductions you have claimed, under which sections you are claiming, and you will also show how much is your tax liability and the details of the taxes which you paid during the year. All these details you will file in a return, in a form, it is called a return of income. Now who is required to file this return of income is a big question. Mind you guys, companies and firms including LLP are mandatorily required to file the return of income. Mandatory, even they do not have any income, or they do not have any kind of business, or they did not do any kind of business, they do not have any kind of income, they have losses, whatever it can be, company and firm are mandatorily required to file the return of income. But any taxpayer apart from a partnership firm, LLP and company are required to file return of income only if the total income before claiming the chapter 60 deductions and before claiming, you remember capital gains exemption series is there, 54, 54B, D and 54 EC and 54S. If it exceeds the basic exemption limit, only then you are required to file return of income. So I repeat, if you are a company, partnership firm or LLP, you are mandatorily required to file return of income. Mandatory means in any case you have to file return of income. But in case of all taxpayers other than company, firm and LLP, you have to file return of income only if your total income before claiming chapter 60 deductions and before claiming section 54 series capital gain exemptions, if the basic exemption, if the total income exceeds the basic exemption limit, only then you are required to file the return of income mandatory. Now, every resident person other than a resident, not ordinary resident, shall file return of income if such person. So, in these two cases, you are required to file return of income, but there are some certain criteria of people who are mandatorily required to file return of income. If any resident person holds any asset outside India or has any financial interest in any entity outside India or has any signing authority in any account outside India, means either if you have any asset outside India or you have invested in any company shares or if you have signing authority in any bank account or if you are a beneficiary of any asset outside India, in that case also, in these four cases also, you are mandatorily required to file the return of income. Now, persons other than a company and firm not covered in above points also required to file return of income. These are additional people who are required to also file return of income mandatorily. Number one, if you deposited in a year aggregate more than 1 crore rupees in any of the current accounts, then you are required to file return of income. Or you deposited 50 lakhs or more in any of the savings account in a year, or any one or more savings account in a year, in that case also you are required to mandatorily file the return of income. If you went abroad for a foreign travel and you spent more than 2 lakh rupees, in that case also you are required to file return of income mandatory. And if you spent any kind of electricity expenditure, electricity bill you paid per year exceeding 1 lakh rupees, in that case also you are required to file return of income mandatorily. Turnover of business, if you're doing some business and if your business turnover is more than 60 lakhs or gross receipts from the profession is more than 10 lakh rupees, in that case also you are required to file mandatorily return of income. Or if your TDS TCS someone already deducted more than 25,000 rupees, in that case also you are required to file return of income. If you are a senior citizen, the 25,000 will become 50,000 rupees. So guys, very simple, return of income, these are the cases in which you are required to file return of income. Lot of times in MCQs case-based scenarios, they may test you on these things. You have to read this chapter without fail, guys. Very, very important chapter. Next one is due date of filing written off income. So when shall I file the written off income, sir? If you are required to get the transfer pricing audit. See, transfer pricing audit is actually, you will learn in your CA final. So if you are required to get a transfer pricing audit, in that case your due date is 30th November of assessment year. What is the previous year and assessment year, you know very well. So for the previous year, whatever incomes you earned, you will file the written off income in assessment year. So 30th November of assessment year is the due date. If you are a company other than the TP audit case, because TP audit case 30th November is given. So if you're a company other than a TP audit case, or you're a person whose books of accounts are audited under any law, or you're a partner of a firm which is liable for audit, if you are any of these cases, then 31st October of assessment year is the due date. So you're a company or you're a partnership firm whose books are required to be audited, tax audit. In that case, 31st October. In all other cases, it is 31st of July. Now, here partner is given. Very simple, guys. If the partnership firm is required to get the books of accounts audited, in that case, the partner of such partnership firm is also, for that partner also, the due date will become 31st of October. And if the partner is governed by Portuguese Civil Code, even that partner is covered here. Got it? Next. Loss return. Guys, you must have read in your set off and carry forward of losses. There are some losses which you cannot carry forward if you did not file the written off income before the due date of filing written off income. So loss return means what? For carry forward of losses, below losses, it is mandatory to file written off income on or before the due date. Sir, what are those losses which we cannot carry forward if the written off income is not filed within due date? First one is business loss, speculation loss, specified business 35 AD loss, capital loss, or loss from owning and maintaining racehorses. These are the losses you cannot carry forward if the written off income is filed after the due date. It is mandatory to file the written off income before the due date itself. But mind you, house property loss and unabsorbed depreciation, you can carry forward even if the written off income is filed lately. Belated return means, let's say for example, if you missed the deadline of these due dates, still you can file written off income. But up to what date? You can file the written off income maximum before 31st of December of assessment year. So this is called belated. Belated means what? After the due date of filing of written off income, you are filing. Second chance the government is giving. But that due date is 31st of December of assessment year or before completion of assessment, whichever is earlier. But what will happen, side effects of belated return. If you file written off income lately, what are the consequences? You cannot carry forward specified losses, which we just now spoke about. You cannot claim certain deductions like 80JJAA, 80 QQB, RRB. You cannot claim 10AA deduction. You have to pay 234A interest if you remember, and 234F late fee also you have to pay. The next one is revised return. Say for example, you filed one return, original return, you made some mistakes in that. You want to revise, you want to rectify the mistake. Then in order to rectify that, you can file a revised return. Sir, can I file, let's say for example, sir, I filed my original return itself belatedly. Can I revise my belated return? Is a doubt. Sir, I am already filed a loss return. Can I rectify that? Can I revise that return also? Yes, you can rectify. Just a second. Excuse. So guys, you can revise original return, belated return, loss return, any return you can revise if you have done some wrong or if you filed some misinformation. And the due date, guys, very surprisingly, the due date of revised return and the due date of belated return, both are same. Both are same. Here also the due date is given same 31st of December of assessment year. So before completion of assessment or before 31st of December of assessment year, whichever is earlier, you have to file the revised return. Once you file revised return, it will replace the original return whichever you filed. Sir, how many times can I revise, sir? Let's say for example, first time I revised, sir, There also I did some mistake. Again, I want to revise. Can I do it? Yes, you can revise any number of times, but you have to revise it before 31st of December or before completion of assessment, whichever is earlier. Any number of times you can revise. Then comes a defective return. Let's say, for example, while filing return of income, I told you there are different forms, ITR 1, 2, like this, different forms are there. You are actually required to file return of income under ITR 1, for example. But by mistake, you filed in ITR 2. Is it correct? No, it is a defective return. Or let's say, for example, you forgot to attach a proof of payment of tax. Even then, it will be called as defective return. And let's say, for example, along with the tax return, you forgot to attach the tax audit report. Even then, it will be called as defective return. So if it is a wrong form, wrong ITR form, or proof of tax is not attached, or you forgot to attach the tax audit report, in these cases, the return will be called as defective return. Once it is a defective return, the income tax department will send you one notice. Please rectify this defect, they will tell. You have to rectify the defect within 15 days or whatever date is mentioned in the notice. If you do not rectify within the date given, then it will be treated as invalid return and it will be treated as if you have not filed any return of income at all. Then comes self-assessment tax. Guys, there are two kinds of taxes: advance tax, self-assessment tax. Advance tax is the tax which you pay during the previous year in which you earn income. Self-assessment tax is the tax which you pay in the assessment year at the time of filing return of income. So at the time of filing return of income, how will you compute self-assessment tax? First, you will compute your total income and tax liability. You will reduce all your advance tax, TDS, TCS, everything. Then you will arrive at self-assessment tax. This self-assessment tax, you have to pay the self-assessment tax before you file the return of income. So before filing return of income, the assessee shall pay the self-assessment tax. If you do not pay self-assessment tax or you paid short, means you paid less self-assessment tax, in that case you may be required to pay fees, interest and balance towards taxes. Are you getting it? So whatever short payment of tax has happened, and when you will adjust the tax already paid, you will adjust in the bill order fees, interest and bill balance towards the taxes. So let's say, for example, you paid 10,000 of self-assessment tax. Out of the 10,000, they will first adjust with the fees, then they will adjust with the interest, then the balance they will adjust with the taxes. Next one, updated return. Guys, say for example, the last due date of filing belated return and revised return is 31st December, correct? 31st December of assessment year. Say for example, that due date is also gone away. Then do you have a chance to file return of income or not is a question. Or let's say, for example, you filed a revised return. Just give me a second. You filed revised return. You rectified some mistake. Still some mistake is persisting in your original return. You want to rectify that also. Is the option available after 31st December is the question. Yes, the option is available and that is called as updated return. From 1st April 2022, government introduced updated return concept, where you can file a return belonging to earlier previous years, even though the belated return due date, revised return due date is already expired. But the updated return should be filed only if certain conditions are met. So updated return can be filed even if original return, revised return, belated return is filed or not, does not matter. You can still file an updated return. Due date shall submit updated return within 48 months. 4 years time they are giving extra from the end of relevant assessment year. From the end of the assessment year for which you want to file return of income, 4 years time they are giving 48 months of time. Now, this is the most important part. You cannot file an updated return in the following cases. Number one, if you want to claim any loss in the updated return, it is not possible. Updated return cannot be a loss return. You should only offer income and you should end up paying taxes. Updated return is already filed. You already filed one updated return, you cannot revise updated return. Only one chance. Updated return if it results in decrease of total tax liability or generates a refund or increases existing refund, you cannot file an updated return. So I told you already, you cannot increase your losses, you cannot increase your refund, you cannot decrease your total tax liability. You have to either nil, there is no impact, or there should be impact of high tax liability. Then only you can file updated return. If original return of income is a loss return, updated return can be filed only if it is a positive return. So earlier you filed loss return earlier in the assessment year. Now if you want to file updated return, it should be a positive return only. It can never be increase in losses. If filing of updated return results in decrease in quantum of carry forward of losses on unobserved depreciation or AMT credit, updated return shall be filed for each such subsequent year. Say for example, there is a change in the carry forward of losses in a particular updated return which you are filing, then for all the subsequent years you have to file updated return, because of course 1 year if you are changing the carry forward of loss, it will have an impact on the other coming years also, no? So you will have to file return. Now, computation of additional tax. Whenever you will file updated return, you have to pay additional tax apart from the original tax which you are required to pay. If the updated return is furnished after expiry of a time under section 139(4) or 5, but before 12 months from the end of relevant assessment year, means from the end of relevant assessment year within 12 months if you are filing updated return, in that case you have to pay additional tax of 25%. 25% of tax plus surcharge plus cess plus interest. If you're filing after expiry of 12 months from the end of relevant assessment year, but within 24 months, before 24 months, in that case 50% additional tax. Let's say for example your tax liability is 1000, you will pay 1500 rupees as tax. 50% extra tax you have to pay. And if you're filing updated return after 24 months but before 36 months, in that case 60% additional tax you are required to pay. If you're filing return of income after 36 months of end of relevant assessment year, but before 48 months of end of relevant assessment year, you have to pay 70% extra additional tax. Next, permanent account number. In this table, we will understand who are required to have a PAN, who are required to apply for a PAN. Your parents must have also applied for PAN, no? But who are the persons actually required to hold a PAN in India? If your total income is likely to exceed basic exemption limit, in that case, you have to apply for a PAN in that year. Or if you have a business or profession where the turnover or gross receipt is likely to exceed 5 lakh rupees, in that case also you are required to apply for a PAN. If you think you want to get into a financial transaction of 2,50,000 or more, any kind of a financial transaction, you are required to have a PAN. Or if you are a managing director, director, partner, trustee, author, founder, karta, CEO, any of these positions you are holding, in that case you are required to have a PAN. And anyone wants to create a trust, in that case also they have to apply for a PAN. Persons thinking to enter into following transactions. If you plan to enter into any of these transactions, you are required to have a PAN. Cash deposit if you want to do in a bank, aggregating 20 lakhs or more in a financial year, PAN is required. Cash withdrawal, you want to withdraw from bank 20 lakhs or more, PAN is required. If you want to open a current account or cash credit account, PAN you have to apply. First you should have a transactions requiring quoting of PAN. Lot of times when you go to bank, they'll tell write PAN number here like that. So what are those transactions in which you have to mandatorily quote the PAN number? Whenever you purchase a motor vehicle other than two-wheeler, you have to quote PAN number there. You have to write the PAN number in the form. If you want to open any account with any bank or a cooperative bank, PAN you have to mention. If you want to apply for a credit or debit card, PAN number is required. If you want to open a demat account, PAN is required. If you want to go to hotel or restaurant where you want to pay a bill of more than 50,000, they will ask you PAN number. If you want to travel to a foreign country and if you want to spend more than 50,000 for forex, foreign exchange, in that case also PAN is required. If you want to purchase or make any payment for a mutual fund, that is also PAN required. If you want to acquire any debentures or bonds, or you want to make any payment to RBI for acquiring bonds, or you want to purchase any bank drafts, or you want to make any fixed deposit with bank, all these transactions require mandatorily to have quote the PAN cards. If you want to go and buy prepaid payment instruments, like you want to take one bank draft, demand draft, there also PAN is required. The limits are given here. If you want to take any life insurance and you want to pay life insurance premium, or you want to sell or purchase any securities, you want to sell or purchase any unlisted shares, you want to sell or buy any immovable property, or you want to sell or buy any goods about 2 lakh rupees, in this case you have to mandatorily required to put the PAN number. Just have a glimpse and go for examination, because maybe one MCQ they may be asking. Now, person not required to update PAN. Sir, are there any people who are not required to have a PAN? Yes, minors are generally not required to have a PAN. They can quote the PAN of their parents. Getting it? Yes. Interchangeable use of PAN and Aadhaar. Sir, I do not have PAN card, sir, but I have Aadhaar number. Can I write Aadhaar number there, sir? Yes, you can write, provided your Aadhaar is linked with PAN, then only you can quote. Or has not been allotted a PAN. If you are not allotted a PAN, then only you can quote Aadhaar number. That too, if the PAN is linked with Aadhaar, then only you can quote. Got it? Next, penalty for failure to comply with 139A. Let's say, for example, you did not apply for PAN. In that case, what will happen? 10,000 penalty will be levied. Now, quoting of Aadhaar number. There are some places in which you need to quote Aadhaar number mandatorily. Two are the scenarios. Whenever you apply for a new PAN card, you must write your Aadhaar number. And whenever you file return of income, it is mandatory to write and quote the Aadhaar number. Sir, if the person do not have Aadhaar number, what he will do? Earlier, there was an option of quoting of enrollment ID of Aadhaar. When you go to apply an Aadhaar card, they'll give you an enrollment ID acknowledgement. That number you can quote. But mind you, recently there has been amendment. Now you cannot quote enrollment ID of Aadhaar number. Aadhaar number itself is required. Enrollment ID is not valid nowadays. From 1st October 2024, this change has happened. Enrollment ID option is not available, and if any person applied for PAN on basis of enrollment ID, he is mandatorily required to intimate Aadhaar number to department up to 31st of December. So earlier you obtained PAN by quoting the enrollment ID, then now within 31st of December 2025, you should go to Income Tax Department and give your Aadhaar number. After 1/10/2024, you cannot quote enrollment ID of Aadhaar. You have to give the Aadhaar number only. Next, every person already holding PAN on 1st July 2017 shall link Aadhaar with PAN. I told you already, linking of PAN with Aadhaar is very, very important and mandatory. Otherwise, your PAN will become inoperative. But there are some cases in which having Aadhaar number is not mandatory. First one, the persons who reside in Jammu and Kashmir, Meghalaya and Assam, for these people, having Aadhaar is not mandatory. Next one, non-residents, or a person having age of 80 years or more, or a person who is not a citizen of India. These people are not required to quote Aadhaar number. Now, where a person fails to link his Aadhaar with PAN, of course, the PAN will become inoperative. If you want to link now after the last date which was given 1st of April 2022, you have to now pay a fees of 1000 rupees under section 234H. Scheme for submission of return through tax return preparer. Guys, everyone do not have knowledge of Income Tax Act. You need some help to file the return of income. How do you know without learning the income tax law? How do you know how to compute total income? What is your tax rate and how to compute tax liability and all? How do you know? So you need some help. So government came up with a scheme called as tax return preparer scheme. In this scheme, so government, the income tax department conducts examination. Even if you clear your CA intermediate, after that you can write this exam, tax return preparer exam. If you write that exam, you will get one certificate, TRP certificate from Income Tax Department. You are a authorized TRP person and you can file return of income of people and you will get fees. So CBDT frames a scheme where it conducts examination for tax return preparers. TRP means an individual who is authorized to act as a TRP by the CBDT. But mind you, following persons cannot become a tax return preparer. Number one, full cleared chartered accountant, legal practitioners, office of a scheduled bank, any employee of a specified class of person cannot become a TRP. Means a semi-qualified CA, semi-qualified CMA, semi-qualified CS, they can write exam and they can become TRP. But if you are qualified, then you cannot. Are you getting it? But sir, can I do tax audit also, sir? No, you cannot do. And you cannot file return of income of a company. Other than company, any taxpayer's return you can prepare, but you cannot do tax audit also. So specified class of person means a person who is required to file return of income other than a company, and you cannot do tax audit as well. Are you getting it? So basically a TRP can actually file return of income only of individual and HF only, not of other taxpayers. Next, verification of return. What is verification of return means? Once you file all the details, in the end you will write, I hereby declare that whatever information given in the tax return is correct. Like that you will write and sign. That is called verification. Who can sign the return of income? If you are an individual, you yourself can sign the return of income. But let's say, for example, if an individual is not mentally proper, then any competent person can actually sign. In case of HUF, actually Karta can sign the return of income. Who can sign? Verify means signature in the tax return. Who should do it? If Karta is not competent, then any adult member of HUF can sign or verify. In case of partnership firm, managing partner. If that managing partner is not there, then any other adult partner can sign. In case of limited liability partnership, designated partner can do. If there is no designated partner, then any other partner can do. If it is a then managing director should sign. If there is no managing director, then any other director. If the company is going into liquidation, the liquidator will sign. If the company is going for insolvency, then that IB professional will do. If it is a political party, the CEO of the political party shall verify. If it is a local authority, principal officer will verify. And if any other person, then competent person should verify. Mind you, if the return of income is not verified, then it will be called as invalid return. So this is a small chapter, guys. Return of income. Just read. Definitely 4 marks definitely will come from this chapter. Pakka it will come, no doubt. So guys, this ends up the full marathon of the income tax paper for your CA intermediate examinations. If you genuinely, guys, if you liked it, please hit a like button and write in comment section what are your thoughts about the way we taught the marathon. And guys, I believe in manifestation. If you really think you want to clear your examination, start manifesting. On Instagram, you must have seen how many big celebrities claim that they manifested their destiny and that is why they achieved their goals. So if you keep manifesting, I am going to clear my examination, I am going to clear my examination, you will definitely clear. So write in the comment section with positivity, I am going to clear my so and so attempt examination. You will definitely clear. Manifestation is true. Trust me on this. If you write in the comment section, you will clear, guys. 100% I am telling you. Manifest. Whatever you think, always think that you are going to clear examination. Always think that you are working hard. Guys, marathon is not just the only video which I provide for your examination. I will be coming up with super questions, super adjustments, all this before your examination. So if you are new to my channel, please do subscribe to the channel. Hit the like button and share this video with your friends also who want to take the benefit of this kind of marathons. Okay guys, chalo. All the very best for your examination. See you in the next video. Take care. Bye-bye. So let's begin our next topic, which is income from other sources. First, see, we already know there are 5 heads of income under Income Tax Act. salaries, PGBP, income from house property, capital gains, and income from other sources. If you look at those four heads, salary or PGBP or capital gain or income from house property, there are specific incomes which are getting taxed under these heads. So if any income is not specified under those four heads, it will automatically get taxed under this head, which is income from other sources. Any income which is not taxable under the head salary, income from house property, PGBP or capital gain shall be taxed under income from other sources. Is it clear? Now, there is a charging section which is the section 56, which gives you a list of incomes which will be taxed under income from other sources. The first income given is dividend income. What is a dividend? If a company earns very good profits, it will give away those profits to owners of the company. Who are the owners? Shareholders. So if any profit is given to the shareholders, that is called as a dividend, and that income whatever received by the shareholder is called as a dividend income, and that dividend income will be taxed in the hands of the shareholder. Is it clear? Now, there is a concept called as a deemed dividend, boss. There is a concept called as a deemed dividend. Sir, what is this deemed dividend? It actually is not a dividend, but the income tax act will deem that as a deemed dividend. Let me take one example. In the first example which I told you, that if any profits of the company are distributed to the shareholders, then whatever shareholder is receiving, that income will be taxed as dividend. Yes or no? But let's say, for example, the shareholder is majority shareholder in the company. He controls all the management in the company. Then let's say, for example, he don't want to pay tax on the profits which he is taking from the company in the form of dividends. He don't want to pay any tax on the dividend income which he is taking from the company. In that case, he will think to do one thing. What you know? Okay, boss, don't give me the profits in the form of a dividend. Let me take the asset of a company. Let me repeat. Let's say, for example, the shareholder who is having the majority shareholding in the company wants to plan is a tax planning in this way. Rather than taking the profits in the form of dividend, what he will do, he will take off one asset from the company. Even in that case, that will be deemed as dividend, and that will be taxed. So in the first scenario, if he receives profit as it is, it will be called a dividend in his hands, and it will be taxed. So what people started doing, rather than taking the profits in the form of cash, they started taking the profits in the form of asset. If he will take, he will go and outside the market, he will sell it off, and he will convert into cash. Are you getting this? These kind of transactions are also deemed as dividend, and the deemed dividend is a concept given under section 2 clause 22a to clause 22f. Are you getting this? So under section 2 clause 22, whatever whatever transactions are notified, all those transactions will be deemed as dividend. They prima facie may not look like dividend, but they are deemed as a dividend by the income tax department under section clause 22. First section is 222a. Under this, what does it say? Distribution of assets from the accumulated profits of the company. Now let's break this in a bits and pieces. Distribution of asset from the accumulated profits. Distribution of asset, the very example which we just now discussed. Distribution of asset from the accumulated profits. What is accumulated profit? Accumulated profit is nothing but reserves. Reserves, there may be two types: revenue reserve, capital reserve. Are you getting this? There may be these and all you would have already read in your accountancy. There are two kinds of reserves. One is revenue reserve, the other is a capital reserve. Yes or no? So whatever reserves the company has, that is accumulated profits only. No, if once the company earns profits, out of that little bit is already given as the dividends to the shareholders. Whatever is left out, that will be called as reserves only. Where you will see reserves in the balance sheet, on the liability side, just below the share capital, you will see reserves. Are you getting this? Any distribution of accumulated profits, whether capitalized or not, by a company to its shareholder is deemed as dividend. Sir, I am not understanding, sir. Any distribution of accumulated profits, we are understanding that the distribution of accumulated profits, reserves in hand, whether capitalized or not. What is this, sir? see whether capitalized or not, we will understand with the help of a example. What is that example? Let's have a look. Meaning of accumulated profits whether capitalized or not. What does the term accumulated profits whether capitalized or not means? Let's have a look with this example. You will first not look at this table first. You will only look at this balance sheet which I have given here. Are you getting this? So you will not look at this balance sheet. Sorry, you will not look at this balance sheet for time being. You will only look at this balance sheet first. Let's understand what is there in the balance sheet. Balance sheet before bonus issue. So this company has not given any bonus yet. Plain balance sheet it is. Share capital is 100, reserves it is 75, liability it is 25. Fixed assets 125, current assets 75. Total is matching. Yes, matching 200. Tallied. Now, if the above company, Thalaiva Limited, declares bonus issue of one bonus share for every 4 equity shares held, then bonus shares will be of 25 crores. Yes or no? 100 crores is the share capital. If for every 4 shares, for every one 4 shares, 1 share if it is given as bonus, then 100 by 4 will be 25. No, that much bonus means the share capital will now increase from 100 to 125. No, earlier it was 100 plus bonus issue if it is done 1/4 of 100, in that case plus 25 it will add. So total share capital will become what? 125. Yes or no? So share capital, let's see, has it become 125? Yes, it has become 125. But where from this 25 crores of bonus amount will come? It will come from the revenue reserves which are there from the with the company. So revenue reserves with the company are 75 crores. If from 75 crores 25 crores is used for bonus, then it will reduce or increase. The revenue reserve will reduce or increase. It will reduce, no da, because 25 out of 75 is already used for a bonus issue. In that case, the revenue reserves will fall down to 50. Yes or no? Yes, it has been fall down to 50. Now that 25 out of the revenue reserves, whatever you utilized for a bonus issue, you have capitalized. No, from reserves it has converted into share capital. So this transaction is called capitalization of reserves. So from a revenue reserve, that reserve have been converted into capital reserve. Are you getting this point? This is called a capitalized reserve. Now, whatever reserve is still pending 50 crores, it is called what? Non-capitalized reserve. No, wherever you will read accumulated profits, whether capitalized or not, in this thing, capitalized is at 25, which you have converted into bonus share. Not capitalized is that 50 rupees, which is a now. Even in this balance sheet, total reserves is 75 only. Even in this balance sheet, total reserves is 75 only. Just that here 75 total is a non-capitalized reserve. Here 75 total reserve. Out of that, 25 is capitalized reserves and 50 is non-capitalized reserve. Are you getting this point? This point is very, very beautiful point. Now, accumulated profits after bonus issue will remain 75 crores only. Capitalized profits of 25 crores and revenue reserves are of 50 crores. Now, what is the link of this example with this section 222A which you are teaching, sir? Any distribution of accumulated profits, whether capitalized or not, by a company to its shareholder is deemed as dividend. I told you. If accumulated profits are distributed in cash, it is dividend in the hands of shareholders. Yes or no? Where from you will give dividends? From the reserves only? No. If you give in the form of cash directly, that is called as a dividend directly. But if accumulated profits are distributed in kind means what? You have given a asset. You did not give any cash. Asset means maybe a machinery is taken by the shareholder. Then the market value of such asset distributed on the date of distribution shall be deemed as a dividend in the hands of shareholder. Let's say for example, in the example which we saw, out of this fixed assets of 125, boss, let's say for example, out of 125 total amount of fixed assets, you have given 10 out of 125, only 10 rupees worth of asset if you have given to a shareholder. In that case, that 10 rupees will be deemed as a dividend. I repeat, up to 10 rupees, whatever you have given will be deemed as a dividend. Now, let's say for example, We already saw that the total reserves in this company's hands is how much? 75. No, total reserves in the hands of a company is 75. Yes or no? And the total assets is 125. Yes or no? Let's say for example, you have given closely, slowly I am repeating, so just to focus. 75 is total reserves with the company, total assets with the company are 125. Let's say for example, you have distributed 90 rupees worth of assets from this 125 to the shareholders. In that case, to the extent of reserves, it says, what is the language used in the section 222? To the extent of reserves, whatever assets you distribute, only to that extent it will be deemed as a dividend. So out of 75 of reserves, let's say for example, fixed assets you distributed to the shareholder is only 90 rupees. Out of 125 of a fixed asset, 90 worth of a fixed asset you have given to your shareholders. In that case, total 90 will not be deemed as dividend, because your reserves are only 75 rupees. So to the extent you have the accumulated profits or reserves, only to that extent whatever assets have been distributed to the shareholders will be treated as deemed dividend. In this example, if let's say for example 60 rupees worth of assets are given, then total 60 will be deemed as dividend, because 60 is less than 75, means within the reserves only. If the fixed assets are distributed 100 rupees, in that case only 75 will be deemed as dividend. Are you getting this? If 80 rupees worth of assets are given to shareholders, then only 75 will be deemed as dividend. If 50 rupees worth of assets are given to shareholders, in this case only 50 will be deemed as a dividend in the hands of shareholders. This same concept of whether capitalized or not, and to the extent of accumulated profits will apply throughout section 222 A, B, C, D, E, F. Are you getting this point? Okay. In case of a bonus shares, there is no release of assets, hence there is no deemed dividend, because we saw that in the case of a bonus issue, just that the capitalization of profit happened, but no asset has went out of the company. Next, distribution of debentures, deposit certificates to shareholders, and bonus share to preference shareholders. If you give to your existing equity shareholders any debentures or deposit certificates or bonus shares to the preference shareholders, in that case, to the extent the company has accumulated profits, whatever you gave the worth of debentures or deposit certificates will be deemed as a dividend under section 222B. In the case of liquidation, you know that in the case of liquidation, the company, what it does, whatever is left out assets are there, it will distribute to its shareholders. If in that event of liquidation, any assets are distributed to the shareholders, to the extent the company has accumulated profits, whatever distributed to the shareholders will be deemed as dividend in the hands of shareholders. 222D, distribution on reduction of capital. Reduction of capital is what? Let's say for example, the face value of the share, the face value of the share is 10 rupees, and by 2 rupees the share is getting reduced, then the face value of the share will convert into 8. No, so if you are reducing the face value, means you are giving back 2 rupees to your shareholders. At the time of giving back this 2 rupees, to the extent of accumulated profits whatever are there with the company will be deemed as dividend in the hands of shareholders. Now, so this is a very beautiful section 222E. If to a shareholder, any closely held company, let me explain you in a pictographic form. There is a private limited company, boss. Technically, in the section 222, it call it as a closely held company. It is called closely held company. Generally, closely held company means a private limited company. If a private limited company gives any loan to its shareholder who has a substantial interest in the company, if a private limited company gives loan to a shareholder who has substantial interest in that company, in that case, to the extent of the accumulated profits held by the company, that loan amount will be treated as a deemed dividend. So loan also, sir, yes, even if a loan is taken by a shareholder, in that case it will be deemed as a dividend in the hands of shareholder. Are you getting this? Now let's look at this. Advance or loan. Advance or loan by a closely held company means a private limited company to its shareholder. Advance or loan given by closely held company to shareholder who is having beneficial owner of 10% or more of the, so that shareholder should have at least 10% of the share capital, and that kind of a shareholder, if he is taking any loan from the company, that will be deemed as dividend in the hands of that shareholder. Now, Advance or loan given to concern means, let's say for example, if your loan you are giving, if the company is giving loan to shareholder, that is treated as dividend, deemed dividend in the hands of shareholder. But rather, if the company plans to give not loan directly to the shareholder, if I am a shareholder, if I am receiving loan from the company directly, it is getting taxed in my hands as deemed dividend. So what I'll think, okay, let me do one thing. Let me do one thing. This is the company which is giving loan. I am a shareholder. So if I am receiving loan, I am getting taxed, deeming this loan as a deemed dividend. Correct or not? Deemed dividend. Like this, I am getting taxed. So I'll do one thing. I am a partner in a partnership firm. Partnership firm, I am a partner, shareholder. I will tell my company, don't give me loan directly. I am getting taxed on that amount which I will receive. So rather you do one thing, you give that loan to my partnership firm in which I am partner. From there I will take the money. Are you getting that? So if you do any kind of this transaction, in that case also, even if this private limited company, the closely held company, if it gives loan to any concern, means what? Partnership firm in which this shareholder has substantial interest, and then whatever loan given by the closely held company to this concern in which a shareholder has a substantial interest will also be deemed as a dividend only, means you cannot escape taxation altogether. Now, advance or loan by a closely held company to a specified concern. Now, what is a concern, sir? It may be HUF in which you are a member, or it may be firm in which you are a partner, or AOP or BOI, or a company in which another company. The shareholder of the company holding more than 10% of the equity shares is a member or a partner or having substantial interest. What is a substantial interest in the concern, sir? At least 20% income share you have in that concern, that will be called as a substantial interest. Exceptions: if loan is granted in the ordinary course of business, let's say for example, the company in which you are a shareholder is a bank, and the bank's general business itself is giving loan. In that case, a deemed dividend concept will not apply. Next section is 222F. Very beautiful and recent brand new section. We have seen this already in the case of capital gains chapter, which is a buyback of shares. There is a cutoff date before 1/10/2024 and after 1/10/2024. Now, if the buyback happens before 1/10/2024, the company is liable to pay tax on that buyback. If the buyback happens after 1/10/2024, then whatever, to the extent of accumulated profits, whatever buyback amount the shareholder will receive, straight away total buyback amount will be deemed as the dividend in the hands of a shareholder. Okay. So after 1/10/2024, nothing will be taxed in the hands of company, only in the hands of shareholder who is getting that buyback amount will be treated as a deemed dividend under section 222F. Are you getting this? We have already discussed in detail the buyback concept in the capital gains chapter. Now, there are some casual income. So whatever we have seen so far, it is only from the standpoint of dividend income. So much story was there. Now we will look at other incomes which are taxable under the head income from other sources. Casual income means you casually play some games, winning from lotteries, crossword puzzles, races, card games, other games, that will be straight away taxed at the rate of 30%, and the head under which it is taxable is income from other sources. Interest on compensation received on compulsory acquisition. You remember compulsory acquisition we have read in PGBP, yes or no? If compulsorily your asset has been acquired in capital gains chapter also we have read, if any capital asset has been compulsorily acquired, that is deemed as a transfer and all, yes or no? So if any compulsorily asset has been acquired and any compensation you will receive, no, they will generally delay the compensation. Let's say for example, in this year my asset was compulsorily acquired, but I will receive my compensation after 2-3 years. So for 2-3 years, the government will also pay you something called as interest on this compensation. Are you getting that? That interest will be taxed under income from other source. Now mind you, up to 50% of that interest on compensation, whatever you will receive, will be exempt. Interest on compensation or enhanced compensation for compulsory acquisition is taxed under IFOS. 50% of such interest is exempt. Advance money forfeited. Do you remember in the case of capital gains we have read? There is one section which says if the advance money forfeited before 1/4/2014, it will be reduced from the cost of acquisition. Now, if you forfeited the amount advance money after 1/4/2014, in that case, it will be taxed under IFOS. That is getting taxed here. Now, money or property received without consideration or for inadequate consideration. Sir, please explain what is this without consideration or for inadequate consideration. Without consideration means freely you are receiving, boss. You did not pay even a single rupee. With inadequate or for inadequate consideration means you paid some money, but you did not pay for the full value of the asset. Let's say, for example, there is a 1 lakh worth of asset I am buying. 1 lakh worth of asset I am buying. I only paid 20,000 to that person and he gave me asset. That is called inadequate consideration. Without consideration means what? Freely I got 1 lakh worth of asset. Are you getting that? Now, these are the assets which are mentioned if you receive without consideration or for inadequate consideration. In that case, that whatever you have received, the benefit only. No, if you receive something for free, that is benefit for you. Or if you receive something for lesser value, actual value is 1 lakh, you paid only 20,000, then 80,000 is benefit for you. No, that benefit will be taxed in the receiver's hand. Means your hand under the head income from other sources, and that will be taxed under section 56(2)(10). Money or cash, if someone is giving you freely cash or money, in that case whole amount will be taxed under IFOS if the same exceeds 50,000 rupees. So let's say, for example, someone gave you 60,000 rupees, full 60,000 will be taxed in your hand. Someone gave you 40,000 only, then it is not taxed. Are you getting this? So only if it exceeds 50,000, then whole cash amount will be taxed in your hand. Immovable property, land or building you received without consideration. Who will give you? Of course, your parents, boss. You're a parents, but parents are covered under relative definition. If a relative gives you this land or building, that will not be taxed. But let's say, for example, some of your friend has become your chaddipati dost, has become big crorepati, and he saw you poor guy, let me give him a 1 crore worth of building to him. So he gives you freely 1 crore worth of building. He is a friend, not a relative. Then in that case, if a friend gives you anything like that, then whatever value of the stamp duty value of the building is there, that will be taxed in your hands, provided the total amount or the value of the building should be more than 50,000. Just remember one thing, boss, in 56(2)(10), in the case of gifting, if the gift is more than 50,000, only then in that case it will be taxed in your hands. Immovable property you received by paying amount, but you paid only inadequate consideration. In that case, whatever benefit is there, no, that benefit, if it is exceeding 50,000 rupees, then it will be taxed in your hands. Taxable if a difference between the SDV and consideration is more than higher of, if the benefit, if it is higher of 50,000 or 10% of consideration, in that case it is the tax in your hands. Movable property. If you remember property definition, we have read in a capital gains chapter also. Property of any kind, what it will include, what does not include. Likewise, if you receive any movable property without consideration, and if aggregate fair market value is exceeding 50,000, then it will be full FMV will be taxed. If you received for inadequate consideration, then whatever benefit, the difference of FMV and consideration will be taxed if it exceeds 50,000. Now, we will see non-applicability of 56(2)(10). I told you while explaining that if you receive building from a friend, it is taxed, but if you receive from your family, it is not taxed. Why I told? Because it is given exclusively under section 56(2)(10), not applicability of 56(2)(10). There are few transactions in which even if you receive benefit of more than 50,000, but from specified persons or organizations, then it will be not taxed under income from other sources. Any sum of money or value of property received in the following cases shall not be taxed. From any relative. Sir, who's a relative? We will come to that. But any relative, your definition of relative may be different, but you have to look at the definition which is given under Income Tax Act. On occasion of marriage of the individual, from anyone, boss, on your marriage, whatever you will receive, fully exempt. Yes or no? By will or inheritance, let's say, for example, a person has written a will that when I will die, whatever belongs to me goes to this person, and you received any properties and cash, that will be totally exempt. On the death of a payer or a donor, from any local authority, from any university, fund or foundation, from any fund or foundation or university or other educational institution, hospital, medical institution, trust, from or by any trust or institution registered. Then other educational institutions, transaction not regarded as a transfer. If you remember section 47. Then one more important thing here, by an individual from any person for COVID-19 treatment of a self or family member subject to conditions notified by central government. If you satisfy the conditions which are given by the central government, and for COVID treatment, if you had received any money from any person, in that case it will be totally exempt. By a member of family of a deceased person, means let's say for example due to COVID someone has died, and his or her family member, the person whoever has died, his or her family member has received some compensation from anyone, that will be exempt. In the case of death due to COVID, within 12 months from the death, if the family members receive, amount of exemption will be, if the amount is received from the employer, then there is no limit. If any other person gives them the amount, then maximum 10 lakhs will be exempt. What is the conditions prescribed by the central government? Death should the person should die within 6 months from the date of COVID positive report, and he should file the family should file a declaration regarding the amount whatever they received in that financial year. Now just now we saw property or a family, those definitions are given here. What is a property, sir? Means whatever you are receiving, no, if it falls only under this category, that will be taxed. Any other movable assets you are getting, that will not be treated as a gift. Immovable property being land or building or both, if you receive as gift, that is the treated as a property. Shares and securities, jewelry, archaeological collections, drawing, painting, sculpture, any work out of bullion, and virtual digital asset. What is a virtual digital asset? Bitcoin, Dogecoin. Are you getting that? Even those, if you receive, all these will be treated as a gifts and will be taxable. Relative, relative. Who is a relative, sir? Whenever you read this relative definition, think of yourself first. You are an individual. In case of an individual, your spouse means your wife. Brother or sister of the individual means your brother and sister. Brother or sister of the spouse of the individual, your macha machi means your wife's brother, wife's sisters. Brother or sister of either of the parents means your parents' brothers and sisters, your mamas, whatever you call bua and all. Okay, atte or auntie, whatever. Lineal ascendant or descendant of the individual. Lineal ascendants, descendants means your tatas, muttatas, or dadas, pardadas, and your chotus, whatever your next generation. Lineal ascendant or descendants of the spouse means your spouse's parents, spouse of any other person referred in the 1 to 6. So spouses of whoever are mentioned here 1 to 6, all these will be relative, and if anything received from them, then nothing is taxable in your hands. Family means the family will receive during COVID. Now what is a family meaning? Spouse and children of the individual, parents, brothers, sisters of the individual, mainly dependent on the individual who died. Compensation or other payment received from termination of employment will be taxed here. Interest on compensation on compulsory acquisition, we already discussed, 50% will be exempt. The manner. Income chargeable under IFOS only if not chargeable under PGBP. There are few incomes which will be taxed under IFOS only if they are not getting taxed under PGBP. What are these incomes, sir? Income from letting out of or on hire of machinery and plant and machinery. Machinery, plant, furniture, sorry. Furniture and plant and machinery, if you are letting it out. Means if you are not doing business of letting out a furniture or plant and machinery, in that case only it will be taxed here. If your business itself is letting out of a furniture or plant and machinery, then that income will be taxed under PGBP. Letting out of buildings is inseparable from a letting out of machinery and plant. We already discussed this income from house property. Any sum received by employer assessee from his employees as contribution to PF, other fund of a welfare, in that case, whatever employer contribution is there, that will be taxed. Any amount received from keyman insurance policy received by a person who took the policy other than the employer. If other than employer someone took a keyman insurance policy for the employee, in that case it will be taxed in the recipient's hand. Salary received by MP MLA will be taxed under IFOS. We already discussed this in PGBP income. As I told you, sorry, income from salaries, because MP and MLA is not an employee. So no. If you do some offline games, if you participate in some offline games and you win some money out of that game, offline game means lotteries, crossword puzzles, races of horse races, anything, straight away 30% you will have to pay tax. No basic exemption limit, no set off of losses, nothing. 30% plus surcharge pluses, no chapter 6 deduction. Adjustment of unexhausted basic exemption limit is also not available. No chapter 6 deduction, no adjustment of a unexhausted basic exemption limit. Then the same story for online games also. Nowadays a lot of online gaming is happening, no? Yes or no? So if you participate in any of these online mobile games, you won some cash money. That money will also be taxed under section 115 BBJ at the rate of 30%. No, same provision here also. Chapter 6 deduction also not available, and the unexhausted basic exemption limit also you cannot claim. The last one is deductions allowable. Now, what we have seen so far is those incomes. We were only discussing about income which is taxable under IFOS, income which is taxable under IFOS. Now we will look at those deductible expenses against those incomes so that we can reduce our income on which we have to pay tax. Interest expenses spent for earning dividend income or income on units of a mutual fund, maximum to the extent of 20% of such income will be allowed. So if you let's say for example you earned a dividend of 1 lakh, then maximum 20,000 rupees you can claim as a deduction, but that should be interest deduction. Next, no deduction in respect of expenditure is allowed in case of a deemed dividend. So for deemed dividend, you cannot claim any kind of deduction. Any commission or remuneration you pay to a banker, means to a bank, for earning interest on securities will not is allowed. If you are earning some income from letting out of a machinery or a plant or a furniture, which we just now discussed, in that case if you did any current repairs or if you paid any premium for the insurance or normal depreciation also you can claim. In case of a family pension, deduction against income from family pension, if you receive any family pension, if family pension is received, for that a deduction is given to the lower of these three amounts, which is 1/3 of such family pension received, 15,000 in case of optional tax regime, and 25,000 in case of default tax regime. Whichever is lower will be claimed as a deduction against the family pension income. There are some exempt incomes, means these incomes are straight away exempt, boss, under section 10. Interest or money received by us in the credit of non-resident external account. See, non-resident Indians can create account called as non-resident external account, in which they can deposit some amount. On that, if any interest is received, that will be totally exempt. Compensation received on some disaster. Let's say for example earthquake happened, some person lost his life, so any compensation received by family members of that deceased person will be exempt. Scholarship, if any granted for you for some education purpose, that is also exempt. Daily allowance and constituency allowance given to MLAs or MPs are exempt. Payment in cash or kind in respect of government awards. Let's say for example you got Padma Bhushan with 1 lakh rupees, in that case that 1 lakh is totally exempt. Interest on post office savings bank account. In post office savings bank account, if you deposited some amount and if any interest has been received, in that case if you receive interest up to 3,500 in a single account, in that case it is exempt. If it is a joint account, then maximum 7,000 will be exempt. So this ends our discussion on income from. The next topic of our discussion is clubbing of income. Boss, everyone hates to pay tax. No one happily pays tax to the government. So whatever income is earned by the taxpayer is generally the taxpayer will try to pay as much as a less tax. He will not want to pay more tax. So what he will do? He will do a lot of tax planning so that he can save his tax and he can pay very less taxes. But the government will always want the taxpayer to pay more taxes. In this chapter, we will see all those kind of tax planning which a taxpayer does to reduce his taxes, and alternatively also we will see how the government keep a check on these kind of malpractices so the government can get more revenue in the form of taxes. First example, let me take one example, boss. It is a very beautiful example. Let's say for example Virat Kohli and Anushka Sharma. We know that these two are what? These two are married, no? Couple, yes or no? So you can say Anushka Sharma is a spouse of Virat Kohli. Let's imagine Virat Kohli is a salaried employee. Virat Kohli is a salaried employee and his salary, for example, is 10 lakh rupees per annum. So Virat Kohli has a salary income which is 10 lakhs per annum, for example. Okay, and also he owns a house property. He owns a house property for which rental income is 3 lakh rupees. Rental income is 3 lakh rupees. So if you look at this, total income of Virat Kohli will become 13 lakhs. 13 lakhs. Yes or no? Yes or no? Now, in the case of individual, let's imagine this person is paying tax under optional tax regime. Optional tax regime. In that case, what is the slab rate? Do you know what is the slab rate? 0 to 2.5 lakhs, it is 0. 2.5 lakhs to 5 lakhs, it is 5%. 5 to 10 lakhs, it is 20%. And beyond 10 lakhs, it is 30%. Yes or no in the case of individual? Now, just imagine what kind of a tax planning Virat Kohli wants to do. 10 lakhs, up to 10 lakhs salary, so he cannot do anything because that is salary income. He cannot change that. But one change he can do in his total income. You know what it is? This 3 lakhs of rental income, if he plans to tax it in hands of Anushka. Let's imagine Anushka is at a housewife only. She does not have any kind of income. So if Virat Kohli gifts the house property to Anushka, then rental income will be credited in Anushka's bank account, and here from no income, Anushka will get 3 lakhs of income. Then you will be thinking, sir, in Anushka's hand it will get taxed. No, no, boss, because in the case of an individual, there is a concept of a rebate to 5 lakhs. If you are under optional tax regime up to 5 lakhs, you don't need to pay any taxes. Or even if you look at this 3 lakhs, 0 to 2.5 lakhs, 0, 2.5 to 5 lakhs, whatever, 0, 2.5 to 3 lakhs, that 50,000, 5% is how much? 2,500 something. That will get as a rebate. No, nothing, she'll pay tax. Means on this 3 lakh rupees, if it is received by Anushka, then tax on this 3 lakh will become 0. Whereas if that rental income is received by Mr. Virat Kohli only, in that case, 10 lakhs plus 3 lakhs, the income will become 13 lakhs. And on this 3 lakh, which is beyond the 10 lakhs, the tax rate will become 30%, no boss. So on 3 lakhs, 30% is how much? I think it will be, 1 second, 3 lakhs into 30%, 90,000, boss. 90,000 Virat Kohli will pay tax. Why 90,000 he will pay tax? Already up to 10 lakhs of salary, he will be paying tax at the rate of 20%. And extra 3 lakhs, whatever he will get, that will be taxed under a 30% slab. No, because the income is exceeding 10 lakhs already. So, by doing one transaction, Virat Kohli can save 90,000. What is the transaction? He can gift the house property as it is to Anushka. Now you will be thinking, sir, gift will be taxed. No, no, boss. Remember section 47, transactions not regarded as transfer. Under capital gains head, we have discussed. If you gift a property, gift is not regarded as transfer. So very simple. Virat Kohli, rather keeping a house property in his own hand and rather taking a rental income on in his own account, he will do what? Simply he will take the property and gift it to his wife Anushka, and Anushka can happily claim that income as her income, and can claim basic exemption limit or a rebate, and no need to pay any tax on that rental income. Very simple. People used to do this, and that is why government caught all these kind of transactions and changed the law so that even if Virat Kohli gifts the property to spouse who is Anushka Sharma, then the rental income, whatever 3 lakhs fetched by that property, will be taxed in the hands of Virat Kohli only. Now what Virat Kohli thought? No, okay, if I transfer the property without consideration to my wife, then problem is arising. Let me do one thing. Without transferring the property, I will transfer the income only. How? They see, Virat Kohli went to one that agreement fellow, notary people, and he written he prepared one agreement. In that agreement, he wrote, I am not transferring the property, I am transferring the right to receive the rent to my wife. In my property, I do not have right to take that rental income. I am transferring the right to receive the rental income to my wife, Anushka Sharma. He wrote one agreement, he prepared and got it notarized. And like that, he wanted to transfer the rental income without transferring the without transferring the house property itself. Even those kind of transactions are regarded as clubbing transactions, and that rental income will also be taxed in the hands of Virat Kohli. Are you getting this? So these kind of transactions we are going to look at. So what we are going to discuss is an assessee is usually taxed on his own income, but in some cases he may taxed on other person's income. So in our case, we have seen Virat Kohli's income actually, but he transferred the income to Anushka Sharma. Though it is Anushka Sharma's income, it will be taxed in the hands of Virat Kohli only. Income transferred to family members will be taxed in the hands of the transferor. Who is the transferor? Virat Kohli is a transferor. Transfer of income without the transfer of asset. In the example which we have seen, if any person transfer the income with transferring the asset, then such income is to be included in the hands of transferor. Now understand, there are two kinds of transfer. Let's take one more example. Now Virat Kohli understood that, boss, if I transfer asset without consideration or with inadequate consideration to my spouse, then clubbing provisions are getting attracted. If I don't transfer the asset but only transfer the income, still clubbing provisions are getting attracted. Let me think of some other route, and that route is called as a trust route. What is a trust route? See, Virat Kohli simply will create a trust. It is an trust entity, and transfer the house property to trust, rather transferring the house property to directly to Anushka, because if directly it is gifted to Anushka, shipping provisions are getting attracted. So what Virat Kohli thought, let me create one trust. I will transfer this I will donate my house property to the trust. Trust beneficiary, trust owner is everything is Virat Kohli only. Who created the trust? Virat Kohli. In that trust, Virat Kohli will donate or transfer the house property, and in the trust deed it will be written that the beneficiary of the rent should be Anushka Sharma. So rather directly transferring the rental income to Anushka Sharma, indirectly by way of a trust it is getting transferred. Now remember, in the hand of trust, whatever income gets generated, that gets exempted. Yes or no? In the case of a trust, so beneficiary is made as Anushka Sharma, and in the hands of a trust it will not get taxed. So happily that rental income is escaping taxation. This kind of a transaction is by way of a trust. Now in the case of transfer to trust, there are two kinds of transfer, boss. One is called as revocable transfer, the other is called irrevocable transfer. Revocable transfer means the transferor has the right any time to take back that property from the transferee. Irrevocable means the transferor, once he has transferred the property to the transferee, he can never in lifetime he can get back that property ownership. Are you getting that? So in revocable, you have the right to again take back the property from the receiver, but in the case of irrevocable transfer, you can never get back the ownership in that asset. Now let's say for example, let's look at this example which I have given here. In the case of transfer of income without a transfer of asset, if Mr. Vijay gives to his wife Mrs. Basanti the right to receive rent from his property without transferring the property, the rental income will be taxed in Mr. Vijay's total income. Income arising from revocable transfer of asset. See, boss, if it is a revocable transfer, means you have the right to take back the property. In that case, clubbing provision will apply. If it is an irrevocable transfer, means once you transfer the property, in lifetime you can never get back that property in your hands. In that case, clubbing provisions will not apply. So if it is a revocable, clubbing will apply. All income arising to any income by way of revocable transfer of asset is to be included in the total income of transferor. Who is transferor here? Mr. Virat Kohli. As per section 60, the transfer is revocable if it allows the transferor to regain the control over the assets. The clubbing provision applies even if only part of the income from the transfer asset benefits the transferor. Now, if the transfer is revocable, all income from the asset is included in transferor's income. Are you getting it? So the income will be taxed in the hands of Virat Kohli only, even if he transfers the asset to a trust, because it is a revocable transfer. Exception. There is only one exception, boss. If in the transfer of in the transaction of transfer of asset to trust, if though it is a revocable transfer, but you do not have the right to take back the control of the asset during the lifetime of the transferee, only in that case clubbing will not apply. I repeat, let's say for example, in the trust deed it is written that the transferor of the asset does not have right in the asset until the transferee or the beneficiary dies. Until the beneficiary dies, until the beneficiary dies, that kind of a revocable transfer, if it is, means once the beneficiary will die, once the beneficiary dies, this transferor can take back the property. But until the beneficiary of this asset, if the beneficiary of the asset is alive, until then if the transferor does not have any right to take back the property, in that case clubbing provisions will not apply. So clubbing will not apply in below case even if it is revocable transfer. If the transfer is by way of a trust or any other form which is not revocable during the lifetime of the beneficiary or a transferee, but can be revoked after the death of a beneficiary or transferee, in this case clubbing provisions will not apply. Example: Mr. Rajesh transfers his house property to a trust for Mr. Ramesh's benefit until his death. The income from the property is taxed in the trust's hand during Mr. Ramesh's lifetime. After his death, since the transfer becomes revocable, the income is included in Mr. Rajesh's income. Is it clear? Next, clubbing of income arising to spouse. Let's say for example, Virat Kohli is already working with one organization, boss. Please understand this. Virat Kohli is working in an organization where he draws a salary of, let's say for example, 10 lakh rupees. He is drawing a salary. Okay. 10 lakhs rupees he is drawing a salary. And also, let's say for example, in the same organization, Virat Kohli has more than 20% of a shareholding also. More than 20% of a shareholding he is holding already. So means Virat Kohli has a substantial interest in this organization. Substantial interest in this organization, and Virat Kohli is drawing a salary of 10 lakhs for example. Now, 10 lakhs if he is drawing a salary, then we can easily say that from 2.5 to 5 lakhs, the tax will be at the rate of 5%, and 5 to 10 lakhs of income, the tax is at the rate of 20% out of this 10 lakhs, yes or no? But he wants to escape tax. What he will do? He will tell the organization, boss, do one thing, pay me only 5 lakhs of a salary. Rest 5 lakhs you pay to my spouse. We will add Anushka Sharma as an employee in the organization, and you split my 10 lakhs of salary, like 5 lakhs in my hands and 5 lakhs in my spouse's hand. Why it will be, how it will be beneficial for Virat Kohli? Boss, if it is a 10 lakhs, then 1,12,500 tax is levied on Virat Kohli's salary. But if the salary is getting split in 5 lakhs in the hands of Virat Kohli and 5 lakhs in the hand of Anushka, then both individually they are getting only total income of 5 lakhs. Both can take a rebate under section 87A. Then zero tax on this total 10 lakhs of salary. No, then 1,12,500 of tax is saved. No, totally. Are you getting this? So how do they want to save the taxes? So if Virat Kohli plans to do this, in that case, clubbing provisions will apply. Let's have a look at this provision. Income by way of remuneration from a concern in which the individual has substantial interest. So Virat Kohli has substantial interest in an organization, and spouse is getting salary from such an organization. In that case, clubbing provision will apply. But let's say for example, Anushka Sharma is getting salary because of her own talent. She is actually, let's say for example, she is employed as a finance head in that organization. If Anushka Sharma is really a chartered accountant and really genuinely she is working in the organization in which Virat Kohli has substantial interest, in that case clubbing provision will not apply. Any income such as salary, commission, fees received by his or her spouse from a business where the individual has substantial interest has to be included. What is the substantial interest in a concern? If the concern is a company, in that case, if 20% or more of the voting power is with the person, it is called as a substantial interest. In all other cases, minimum 20% or more of the profit share, if any person is having, that will be called as a substantial interest in the organization. However, clubbing does not apply if the spouse earns income on her or his own professional skills. Now, the next one, income arising to spouse from asset transferred without adequate consideration. The first example I took, where Virat Kohli transfers his asset to Anushka Sharma without any consideration or for inadequate consideration. In that case, clubbing will provisions will apply. If one spouse transfers to another without adequate consideration, except in cases of separation, if Virat Kohli and Anushka Sharma plans to get separated, in that case, if asset is transferred to Anushka Sharma, then in that case, the clubbing provision will not apply. Any income from the asset will be included in transferor spouse's total income. If an individual transfers a house property without adequate consideration, the transferor is still the owner, considered the owner, and the property's income is taxed in the hands of transferor's hand. Income arising on transferred assets alone have to be clubbed. Income earned from reinvesting the income cannot be clubbed. Let's say, for example, out of the rental income, whatever Anushka got, she has invested that income in some shares and got some dividend income. That dividend income cannot be clubbed in Virat Kohli's hand. Only that rental income which she fetched from the asset can only be clubbed. The next point is, if assets are transferred to spouse or invested in business. Let's say, for example, Virat Kohli gifts some money to Anushka, and that money she invests in some business. If any profit is earned out of that business, or even if interest on that capital contribution is received by Anushka, even those will be clubbed. If asset is transferred to spouse or invested in business, the income from such investment, including interest from capital contribution, will be included in transferor's income. How much of the PGBP income will be clubbed, sir? Income from business, if you multiply with the amount gifted by assessee, means amount gifted by Virat Kohli divided by opening capital of business on first day of previous year. If you do this, what is that amount which has to be clubbed in Virat Kohli's hand? You can know that much will be taxed in the hands of Virat Kohli. Transfer of assets for the benefit of spouse. If you transfer the asset for the benefit of spouse to someone, and if any benefit is received by Anushka, still that will be clubbed. So the next thing is clubbing of income arising to son's wife. If a mother-in-law or father-in-law transfers an asset without adequate consideration, or without any consideration to daughter-in-law, in that case, if any income is generated out of that asset, in that case, that will be clubbed in the hands of a mother-in-law or a father-in-law. Next thing is clubbing of minor's income. If the child of a parent earns some income out of his or her own talent, in that case, clubbing will not happen. Let's say, for example, the child participates in some national TV program, some competition, and earns some money, prize money. That kind of a money will not be clubbed in the parent's hand, because it is earned by way of his or her own talent. But otherwise, let's say, for example, if the parents transfers any property to the children without any consideration, or even if without a inadequate consideration, in that case, if any income is generated out of the asset, that income will be clubbed in the hands of parent. Sir, in which parent the income has to be clubbed? That parent whose income is higher, in that parent's hand the income will be clubbed. If the parents are divorced, the parent who takes care or maintains the child, in that parent's hand the income will be clubbed. But keep in mind one thing, whenever you are clubbing a minor child's income in the hands of parents, exemption to the parent up to 1,500 will be provided. Let's say, for example, if the child is a disabled person, under section 80U, you see disability, we had discussed in the chapter of deductions. So if a child is a 80U disabled children, and if he receives any compensation from the government, that income cannot be clubbed in the parent's hand. So let's look at these points. All income of a minor is to be included in the income of his or her parents. Manual work, if out of manual work or skill or talent, that should not be included. Parents income whose total income is higher, in that parents hands it will be clubbed. Club if once a minor's income is clubbed with one parent, it won't be included in other parents in future unless the AO wants to change. So if you start clubbing in the income in one parent's hand, then you should keep continuing in that same parent's hand only. If parents are separated, then whoever maintains the child, in that person's hand it will be clubbed. If a minor child has a disability of 80U, then it will not be clubbed. Clubbing provisions are attracted even in respect of a minor married daughter also. Exemption, as I told you already, 1500 will be given. If a house property is transferred, then in that case, clubbing will happen. Now, cross transfer. What is this, sir? See, if Virat Kohli transfers a asset to Anushka Sharma without consideration, then clubbing is getting attracted. Let's say, for example, Virat Kohli has a own brother, and that brother is also married to his spouse. So there are four parties: Virat Kohli, Anushka Sharma, wife and husband, Virat Kohli's own brother, and the brother's wife. So these are the four parties. Now, if Virat Kohli transfers asset to Anushka Sharma, clipping is happening. But if Virat Kohli transfers asset to brother's wife, clubbing will not happen. No. So what Virat Kohli will do? They will get into one agreement. See, boss, he will tell to his brother. Virat Kohli will tell to his brother. See, if I directly transfer her to Anushka Sharma, clubbing provisions are getting attracted. Income is getting taxed in my hand. We will do one thing. You transfer the asset to my wife. I will transfer my asset to your wife. So income you only take. My property's income I will take. Your property's income you take. But on papers it should look like they are only earning income, so that they can claim rebate. If that kind of a cross transfer transaction happens, then also it will get taxed. Let's see one example. Mr. X gifted 12 lakhs to brother's wife, Mrs. Y, and his brother Mr. Y gifted 8 lakhs to Mrs. X. Mr. X's wife gifted amount deposited in bank at the rate of 9%. So if the gifted amount transferred to, if the gifted amount is deposited in bank for interest, then the interest income is getting generated. No, that interest income will be clubbed in those transferor's hands. But here you one very very important point. Clubbing would apply only to the extent of cross transfer of gift. In above example, 8 lakhs is the cross transfer. See, Mr. X gifted 12 lakhs. And Mr. Y gifted 8 lakhs. So how much is cross transfer happened? 8 lakhs only. Are you getting this? So Mr. X gifted to Mrs. Y, and Mrs. X got a gift from Mr. Y. Whatever interest 48,000 is there, no, on 8 lakh rupees, that will get clubbed. Conversion of self-acquired property into property of HUF. Let's say, for example, one of the members of HUF wants to convert his own property into HUF's property. He want to get his individual name's property into HUF's name property. In that case also, clubbing provisions will apply. Next, very very important point, boss. Income only we are discussing so far. Income, not only just income. Even if a loss is generated out of the transferred asset, even that will be clubbed in the hands of a transferor. Not just income. Even if a loss is generated out of the transferor asset, even that can be clubbed in the hands of transferor. Okay, thank you. Next comes advance tax. Very simple, boss. Advance tax means during the financial year itself, you have to assume how much your total income will be, and you have to make a tax payment in installments. You need not wait for the last month to end and then pay tax at the end of the year. Are you getting this? So advance tax means during the financial year in which you will earn income, every quarter you will assume, or you will estimate your total tax liability for the year, and in installments you will pay tax, which is called as advance tax. How much you have to pay tax? And this advance tax concept applies only if you think that, or you estimate that your total tax liability for the year is going to be more than 10,000. If your total tax liability for the year is less than 10,000, you need not pay any advance tax. Advance tax means a tax paid in the previous year in which the income is earned. How to estimate? Method of calculation, very very important. Step 1, estimate the current year income. You have to estimate how much income you are roughly going to earn in this year. Step 2, compute advanced tax liability on estimated income. How to compute, sir? If you are individual, apply the slab rates. Are you getting this? And you can consider any TDS already deducted by any person. Applicability, applicable only if advanced tax liability is 10,000 or more. Note, in the case of a senior citizen who is not doing any business, in that case, no need to pay any advance tax. How much to pay, sir? To 15th of Jan, I told you quarterly you have to pay advance tax. To 15th of June, you have to pay at least 15% of total advance tax liability. 15th of September, 45%, 15th of December, 75%, and 15th of March, by 15th of March, 100% of the advance tax liability means your estimated tax liability has to be fully paid. If the assessee opts for presumptive basis of taxation, PGBP, remember 44AD, minimum 8%, 6% of the gross receipts he has to pay tax. In that case, 100% of the advance tax liability shall be paid before 15 March. Means if you are paying, if you are opting for 44AD optional, the what do you call presumptive taxation under 44AD or ADA or AE, in that case you have to pay advance tax only in a one shot on 15th of March. You need not pay in 4 equal installments. Any tax paid till 31st of March previous year will be considered as advance tax only. Simply to put, during the previous year in which you earned income, you paid any kind of tax, that will be called as advance tax only. Whatever income tax you will pay after the previous year in the assessment year before filing your return of income will be called as the self-assessment tax. Next, delayed payment interest 234A, 234B, 234C. There are three sections, boss. 234A says you have to pay interest if you have delayed filing your tax return. Means, let's say for example, your return of filing, your due date of filing return of income is 31st July, for example. But you filed a return of income in the month of December. Then by how many months you delayed? August, September, October, November, December, 5 months. For these 5 months, you have to pay interest at the rate of 1%, 1% per month. On what amount, sir? On the total tax liability which was pending payable with the tax return. Let's say for example, in the tax return 10,000 tax was outstanding payable, then on that 10,000 into 1% into 5 months you will pay interest under section 234A. Interest on delay in filing of return of income. Formula for interest computation: unpaid tax as per return of income into rate of interest into period. Unpaid tax is what, sir? Remaining tax liability as per return of income after deducting all the TDS, TCS, whatever reliefs you have. Rate of interest is 1% per month. From the date after the due date of filing return of income till the date of actually filing return of income, you have to pay interest under the section 234A. Next interest is 234B. Let's say for example, the advance tax which you paid during the previous year is less than 90% of the total tax liability of the year. Assessed tax means first you paid the advance tax, then the return of income was processed and they will assess some tax no under the normal processing of a tax return. At that time, whatever assessed tax is there, that will be compared with how much advance tax you paid. If you paid more than 90% of the assessed tax, then there is no interest under 234B. If the advance tax what you paid is less than 90% of the assessed tax, what assessed tax means, that tax which you finally you paid a tax on. Advance tax you pay on estimated income. Assessed tax is on the actual income. Are you getting that? Formula: advance tax short paid. Short paid means how much a difference. Rate of interest period. Advance tax short paid means what, sir? Assessed tax minus advance tax already paid. On the difference, you have to pay interest at the rate of 1% per month. From when I have to calculate interest, sir? From 1st April of the assessment year till the actual date of payment of that short tax. Note: interest not applicable if assessee paid minimum of 90% of advance tax payable. 234C. See, advance tax, I told you 14%, 15%, 45%, 75%, 100% of the advance tax liability. You have to pay in 4 equal installments, no quarterly. If you have delayed those advance tax payments, then interest under section 234C will be levied. Interest payable for deferment of advance tax payments.
How, sir? Deferred amount into rate of interest into period. How much is the deferred amount, sir? Deferred amount is given in this column. 15% of tax you are required to pay. 15, 45, 75, 100. Remember that advance tax table. Less advance tax paid till that date. So whatever difference will be there will be what? That advance tax which you did not pay. You were supposed to pay 15% of advance tax liability, but you did not pay. In that case, interest will be levied. First three columns, if you see, it is given 3 months. Last month, it is given only 1 month. Why? Because last month, if you remember the last installment of advance tax, the date given is by 15th March, you have to pay the last installment. So from 15th March, only till 31st March, you have to pay interest. No. So that 15 days is treated as 1 month and you have to pay interest. Now, there is one important note. If the advance tax paid by the assessee on the current income on or before 15th June and 15th September is not less than 12% and 36%, in that case, there is no need of interest. Means in these two installments, boss, if you had paid minimum 12% here, minimum 36% here, you are required to pay 15% and 45%, but you paid 12% minimum and 36% minimum in the second installment, then interest will not be levied. Next, fees for, I'm sorry, fees for a delay in a default in furnishing TDS returns. Let's say, for example, you belatedly filed a TDS returns. In that case, 200 per day will be levied as a penalty or a fees, you can say, for delay in filing TDS returns. But mind you, the total fee which you are supposed to pay should not exceed the TDS amount. 234F will be levied if you file your tax return, income tax return belatedly. How much, sir? If the income which you offered in the tax return is up to 5 lakhs, 1000 rupees you will pay as a delayed fees. If you have a paid, if your total income is exceeding 5 lakh rupees, in that case, you have to pay fees of 5000 rupees. And one more provision, recently Modi told you have to link your Aadhaar with PAN. If you don't link, in that case, 1000 penalty. Now currently 1000 rupees is the penalty. You have to pay penalty and then link the PAN and Aadhaar. Okay, guys, this ends up our discussion. Hi, guys, let's begin our discussion on the next topic, which is deductions from gross total income. First question is, what is gross total income? Gross total income is nothing but the sum of incomes from all five heads of income. What five heads of income we have? Income from salaries, income from house property, PGPP, capital gains, and income from other source. All these individual incomes, if we put together, if we sum up all these incomes, we arrive at something called as gross total income. Gross total income. From this gross total income, an assessee is eligible for claiming deduction under Chapter 6A. Chapter 6A, right from Section 80C till 80 QQB RRB, he can claim deductions. Lot of deductions are given under Chapter 6A. What happens by claiming this deduction? By claiming this deduction, he can reduce his taxable income. So whatever gross total income is there, from that, if Chapter 6A deductions are reduced, that will become your total income or taxable income. So your income tax is finally calculated on this total income. On this total income. Now there are few important points to be noted here. This Chapter 6A deduction is not eligible against special incomes like 112A, 112, 111A under special winning incomes and all. Are you getting this? So deductions you cannot claim against these special incomes. You cannot claim deduction under special income. So whenever you will take this GTI here, you will not include 112A income, 111A income, 112 income, other special incomes. So one more thing, this Chapter 6A deductions cannot exceed your gross total income. Your Chapter 6A deductions, all deductions put together, can never exceed your gross total income, because if it exceeds, then your total income will become negative. So maximum Chapter 6A deduction you can claim is up to the maximum of gross total income. Is that clear? Let's get into the book now. So whatever we have discussed just now is written here. Deductions under Chapter 6A are allowed from the gross total income to arrive at the total income or taxable income on which you will compute your tax liability. Amount of deduction cannot exceed a gross total income. Deduction 6A is not allowed against 112A, 111A, 112 and special incomes. Unclaimed deductions cannot be carried forward to subsequent year. Means, let's say for example, your gross total income is 1 lakh. Your deductions are total deductions are 1,20,000. But we just now discussed maximum deductions we can claim is how much? 1 lakh only. So that left out excess 20,000 deductions which are there, you cannot claim. You can neither carry forward to the next year. Now, very, very important. We know that in the case of individual HUF, AOP, POI, AJP and all, there are two kinds of tax regimes. What are the tax regimes? Optional tax regime and default tax regime. Now, keep in mind, very, very important point whenever you read deductions chapter, number one point, under optional tax regime, all kind of deductions are allowed. Under optional tax regime, all kind of deductions are allowed, but under default tax regime, only three deductions are allowed. What are those, sir? 80 ccd, 80 ccd2, 80 cch2 and 80 jjaa. Under default tax regime, only these three deductions are allowed, boss. Rest all deductions are not allowed. So what is 80 ccd2? Employers contribution to national pension scheme, and 80 ccH2 is central government's contribution to Agnipath scheme, and 80 jjaa is deduction with respect of employment of new employees. These three deductions we will discuss in detail wherever it will come. Now, as I told you already, there are a lot of deductions, boss, under chapter 6A. The first deduction is under section 80C. Under section 80C, this deduction is specifically in respect of specified investments. So in order to claim the deduction under section 80C, you have to make some sort of investments. You have to spend some money. If you invested this money in this list of things which are given under section 80C, you can claim deduction. There is a huge list given. If you invest in any of these things, you can claim deduction under section 80C. First, let's see to whom it is applicable. So it is applicable for individual and HUF. It is applicable only for individual and HUF. Maximum deduction you can claim under this section is 1,50,000. Sir, 1,50,000 for each of the investment? No, boss. For all the investments what are given under 80C, for all the investments put together, maximum it is 1,50,000. What are these investments, sir? The first investment given is premium paid on life insurance. Sir, is it only with the life insurance corporation, LIC corporation only? No, any kind of insurer, even it is a HDFC insurance or ICICI Lombard insurance, any kind of insurance it can be. If you have taken an insurance policy, if you are paying premium for the insurance policy, in that case, that is eligible for deduction here. Sir, for whom the insurance should be taken? If you are an individual, you can take insurance for yourself, means individual, spouse, child, and child can be either minor or a major child. If you are a HUF, in that case, you can take the HUF can take policy for the members of HUF. Now, how much of premium which I am paying is allowable, sir? See, very simple, boss. If you have taken life insurance policy before 1/4/2012, in that case, maximum you can get up to premium of 20% of a sum assured. I repeat, if you have taken policy before 1/4/2012, in that case, the amount of deduction what you can claim under section 80C is actual premium which you are paying, or 20% of a sum assured, whichever is lower will be eligible for deduction under 80C. But if you have taken policy on or after 1/4/2012, in that case, actual premium paid or 10% of sum assured. Sum assured means what? How much of assurance is given by that policy. That. So if the person who is taking the policy is a person with the 80U or 80 DDP disability, and if the policy is taken after 1/4/2013, in that case, up to 15% of sum assured is eligible for deduction under section 80C. Premium paid towards a deferred annuity. Now, whatever we have seen is only LIC, life insurance premiums. There are other items also which are eligible for deduction under section 80C. Let's look at them quickly. Deferred annuity, if you have a deferred annuity premium, if you have paid anything, statutory contributions to statutory provident fund, recognized provident fund, public provident fund, if any of in these funds, if the contribution is made, that also is eligible for a deduction. Even for a public provident fund, the deduction, I mean the contribution can be made for either individual spouse or child or for any member of a HF. If you have made contributions to superannuation fund, or if you have deposited any amount in Sukanya Samriddhi account is for a girl childs. If their parents wants to deposit some amount in this account, that is also eligible. If you have made any investments in the national saving certificates, if you have purchased any annuity plan of a LIC, if you have made some contribution in ULIPs. ULIP is what? Unit linked insurance plans. Or if you have purchased any notified mutual fund units or a unit trust of India units, or if you have made contribution to notified pension fund of a mutual fund or a UTI, or if you have made some term deposits, or if you are paying the tuition fees for your children, but maximum for 2 children it is allowed. Sir, what is a tuition fee? If any college fees, university fees, school fees, or other educational fee, if you are paying for your children, that is also eligible for deduction under section 80C. If you have repaid any loan, now interest on a housing loan is available under income from house property section 24 deduction, but here the principal repayment it is talking about. Okay, so repayment of housing loan principal borrowed from a employer or government or bank anywhere, from anywhere. If you have borrowed, if you are repaying the principal part of a loan for house, then it is allowable here. If you have subscribed or purchased to certain equity shares or debentures or mutual fund, that is also eligible. If you have put your money in 5-year term deposit or notified bonds or 5-year post office time deposit or senior citizen savings scheme or national pension scheme. So there are totally 20 items given, boss, right from LIC, first one which we discussed, till national pension scheme. 20 items, 20 options you have. Wherever you want, you can invest. But mind you, all these 20 items investments put together, the maximum deduction you can claim under section 80C will be 1,50,000. It is not for each item. Is it clear? Now, next one is 80CCC. 80CCC is for a pension fund of LIC. So, if you are making contribution in a pension fund maintained by a life insurance corporation or any other insurance corporation, in that case, maximum 1,50,000 you can claim deduction under section 80CCC. But this is also subject to CCE1 section is there. We will come to that. The next section is 80CCD. So deduction under 80CCD. This is also contribution to a pension fund only, but this pension fund is maintained by the central government. What we have discussed in 80CCD, pension fund was maintained by LIC, but here the pension fund is maintained by National Pension of Central Government. Are you getting this? Now, who is eligible here? Individual is eligible. Mind you, under 80CCD, there are 3 subsections. 80CCD has 3 subsections. 80CCD1, 80CCD1B, 80CCD2. 80CCD1, 80CCD1B, 80CCD2. See, in 80CCD, you can either be an employee or a self-employed person who is making contribution in this pension fund. And 80CCD1B also same, but it is in addition to 80CC1, you are getting additional benefit. So if you are already contributing in 80CCD1, in addition to whatever benefit you are getting in 80CCD1, you will, in addition to that, you will get a benefit under section 80CCD1B also. 80CCD2 is generally for the employer's contribution. 80CCD1 is for employee or self-employed person who are making contributions. And 80CCD1B is in addition to 80CCC1. Are you getting this? Now let's have a look at this. 80CCD1, if you are an employee, in that case, lower of actual contribution or 10% of salary will be given as a deduction under 80CCD1. If you are a self-employed person, in that case, lower of actual contribution or 20% of gross total income is eligible for deduction. Now your doubt will be, sir, what is the salary, sir? What is salary? Salary is nothing but the basic plus dearness allowance in terms. Are you getting this? Next. As I already told you, 80CCD1B is in addition to 80CCD1. How much, sir? Additional deduction of 50,000 other than 80CCD1 you will get. How does this work? Let's take one example. If assessee's national pension scheme contribution is 1,40,000, for example, and the gross total income is 5,50,000. Why they are giving gross total income? Because I told you 80CCD1 is applicable for self-employed also. So self-employed will not have salary. No, he will have what? Gross total income. See here, 20% of GTIE is eligible. Yes or no? So his gross total income is 5,50,000. He made contribution for 80CCD enough of 1,40,000. Then what is the eligible amount which he can claim deduction? 20% of maximum 20% of GTI means 20% of 5,50,000 is how much? 20% of 5,50,000 is 1,10,000. So 1,10,000 he can claim under 80CCD1. And I told you, in addition to 80CCD1, you can claim another 50,000 under section what? 80CCD1B. Yes or no? So 20% of 5,50,000 is 110 here. Another 50,000 if he can get from 80CCD 1B, then total eligible is how much for him? 1,60,000. But how much he has made contribution? 1,40,000 means up to the extent of 1,40,000 he can claim deduction. But first, he can claim deduction of 1,10,000 under 80CCD1 and remaining he can claim under 80CCD1B. Or he can do ulta also. First 80CCD1B he can claim total 50,000 and then remaining he can claim 90,000 under 80CCD1. Is that clear? So 80CCD2, employer contribution by central government or state government or any other employer. So if employer makes a contribution, then automatically it will be taxed as salary in the hands of employee first, then he can claim deduction under chapter 6A. So how much deduction he will get, sir? Deduction if contribution is made by central government or state government means the employee is a government employee. In that case, up to 14% of salary under both the tax regime is eligible. But if the deduction is contribution is made by any other employer, so if the employee is employed by a private organization, in that case up to 10% of salary, if the employee is paying tax under optional tax regime, and 14 up to 14% of salary if the employee is paying tax under the default tax regime. Now keep in mind one thing, if out of this national pension scheme, if the employee withdraws the amount at the time of closure of the national pension scheme account, in that case only 60% will be exempt and 40% will be taxable. Whereas if he withdraws a partial amount before the closure itself, in that case only 25% will be exempt, rest 75% will be taxable. Now there is a section called as 80CCE. There is one big twist here, boss. What is the twist, sir? Very simple. For section 80C, please keep in mind this thing. For section 80C, I told you maximum deduction available is 1,50,000. Yes or no? For again 80CCC, if you remember that pension scheme of a LIC, for that also we discussed that maximum deduction allowed is 1,50,000. And 80CCD1, we have just now seen that 20% of GTI or 10% of salary, whatever. All these three put together, now this section says that all these three sections put together maximum I'll give 1,50,000. 80C they told individually 1,50,000 is the maximum cap. 80CCC the section told that 1,50,000 I will also give maximum cap. And 80CCD1 also has the different limits, but all these three sections put together, now 80CCE says that all these three sections put together maximum you can get is 1,50,000. Copy for you all. Okay. Next, there is a section called 80CCH. 80CCH is applicable in the case of Indian youth who are in the Indian Armed Forces, and if the government makes any contribution to the Agnipath scheme, in that case 100% if the contribution made by government or a contribution made by that young person who is the employee, means that Agniveer, if he also contributes, in that case 100% is allowed as a deduction. Next comes the very important, which is 80D. See, under 80D you can claim deduction for four kinds of expenses, boss. One, medical insurance. If you take a health policy, health insurance policy. Central government health scheme, if you deposit some amount or contribute some amount in a central government health scheme. Preventive health checkup and medical treatment. So I repeat, there are four kinds of payments you can make in relation to your health. Number one, you can either take a health insurance policy. Number two, you can contribute in a central government health scheme. Number three, preventive health checkup you can go for. Preventive health checkup. And number four, treatment of a disease which is there. Out of these four expenses, three expenses are given here, and fourth expense, medical expenditure, is given here. Whenever you read this table, you have to read like this only. Whenever you will read this table, you read like this. Three expenses are given above, one expense is given here. What are these three above and one under, sir? Three out of three. First one is medical insurance premium, which I told you, central government health scheme contributions, and preventive health checkup. Here what is given is medical expenditure. We will look at it in a short while. Before that, for whom this 80D is available, sir? 80D is available for individual and HF. And for whom this expenditure should be done, sir? For this medical insurance, central government health scheme, preventive health checkup, treatment, for whom? If you are an individual, in that case, yourself, spouse, parents, and dependent children only. Simply you can keep in mind, D means dependent children. Parents can be dependent or independent, no issues. In the case of HF, any member of a HF. So next one, mode of payment. Only if you make a payment other than a cash mode other than cash, in any of these four expenditures, then only you are eligible to claim deduction under 80D. Now we will look at, sir, what is the amount of deduction I can claim under section 80D? See, you need to bifurcate this 80D into three categories, boss. Number one, you are taking for yourself, for your spouse, for your dependent children. Parents are not allowed. For parents separately, they are giving one limit. For your family means what? Who? You, your spouse, and your dependent children. You are categorized as a family. Your parents are separate, and the HF, for HF again there is a separate limit. So first look at only this column, boss. Only this column. Okay. If you have a spent for medical insurance premium, central government health in scheme you have contributed, or for preventive health checkup if you have spent anything, all these put together, maximum you can get is 25,000 of a deduction. But let's say, for example, if you or your spouse or dependent children, any of these three people is a senior citizen, anyone, not everyone, any one of you or your spouse or dependent children is a senior citizen, in that case another 25,000 will be added. Means if anyone is a senior citizen, this 25,000 cap will become 50,000 maximum cap it will become. Now let's say, for example, in any of these three people, you don't have a health insurance policy. In any of these three people, you don't have a health insurance policy, then you can claim medical expenses. You can claim deduction of medical expenses. That medical expenses only for senior citizen it is available, which is maximum 50,000. I repeat, if you are taking a health insurance policy or central government contribution, contribution if you are making, or preventive health checkup if you have taken, generally the limit is 25,000. But any of these three people are senior citizen, in that case the cap will become 25,000 plus 25,000, which is maximum 50,000. But let's say, for example, in any of these three, if a person is a senior citizen of 60 years or more, and if there is no insurance, in that case, you can claim something called as a medical expenditure, the actual medical expenditure for which you have spent money. In that case, maximum will be 50,000. Are you getting this? Next, if you are taking a policy for your parents, but for your parents, you cannot contribute for central government health scheme, it is not eligible. If you have taken preventive health checkup for your parents, separately another 25,000. So for your family 25,000, for your parents also 25,000 separately you will get. But if your parent, any of your parent is a senior citizen, there also 25,000 will become a 50,000. So another 25,000 in addition you will get. So if for your parents also, if they are a senior citizen and they don't have a health insurance policy, then they can claim they can claim deduction of a medical expenditure which is spent to the extent of maximum 50,000. In the case of a HUF, for the members of HUF, if the HUF has made payment for any of these expenses, maximum 25,000 is allowable. If any member is a senior citizen, in that case another 25,000 25,000 is eligible. So 25 plus 25 will become 50,000. If the members do not have the insurance, in that case, whatever medical expenditure they are spending, that is eligible for deduction to the extent of maximum 50,000. Now, one thing you keep in mind: for medical expenses, preventive health checkup, insurance premium, even for contribution to central health scheme. Even if you are a senior citizen, normal citizen, anything, full maximum deduction you will get is 50,000 only in each case, boss. Though it may look like here the 25 plus 25 plus 50, oh, 1 lakh. No, da. Full, all these three put together, again maximum under A plus B. What is A plus B? I told you here A. This is all coming under A. This is B. Both A plus B, again it is telling 50,000. Generally in our mathematics, what we were taught, A plus B means what? 50 plus 50, it should be 1 lakh. But in income tax, 50 plus 50 is still 50 only. Are you getting this? So maximum you can get is 50,000 only. And for preventive health checkup, for you, your spouse, dependent children, parents, everyone put together, it should be maximum 5,000 only. For parents separately, 5,000 is not applicable. Are you getting this? Next. If you are paying lump sum premium of a health insurance premium, in that case, how will you claim, how will you compute the deduction? Very simple, just to follow this formula. Lump sum premium, whatever you are paying, divided by total number of previous years of a policy tenure. If you want to understand, you can just have a look at this example. You will understand in a better way. Number of previous years you have to take. Now, the next one is 80DD. Dependent disabled person. For a dependent disabled person, you are taking care of a dependent disabled person. Are you getting it? Maintenance and medical treatment of a handicapped dependent disabled person, for whom it is available, resident individuals and HF. Payment qualifying for deduction: amount of medical treatment, training and rehabilitation of a dependent disabled person. Here the flat deduction is given. Even if you spend 10,000 rupees, 20,000 rupees, does not matter. Flat 75,000 if it is a normal disability for that person. If it is a severe disability, in that case 1,25,000 will be eligible for deduction. Sir, who is the dependent? You can just have a look at this table. You will understand. Next. See, if any amount is received from that life insurance, from the insurance company, at the time of death of that disabled person, in that case, whatever amount received by this person who was taking care of this disabled person will be taxable. If the amount is received while the person who is disabled is alive, then it is not taxable. DDB 80, section 80 DDB, deduction in respect of medical treatment of a specified disease. Specified disease. If there is a specified disease for the eligible persons here, we will discuss that. In that case, if you are spending some money, flat deduction is given here. Resident individual and HF, this is applicable. Payment qualifying: medical expenses incurred for self or dependent person for treating specified disease or ailment. What is the deduction, sir? If you are spending a medical expenditure for normal person, in that case 40,000 or actual expense, whichever is lower, is eligible. If you are spending money for senior citizen, in that case maximum amount you can claim as deduction is 1 lakh rupees. Now, who is a dependent, sir? You can again have a look at this table. Next one is 80U, means the assessee itself is a disabled person. In 80D, he was taking care of some other dependent disabled person. 80DDB, for specified diseases of a dependent person he is taking care of. But in 80U, the assessee himself is a handicapped person. In that case, flat deduction of 75,000 or 1,25,000 is given. If it is a normal disability, 75,000. Severe disability is more than 80% of disability. In that case, 1,25,000 is given as deduction. Next comes 80, section 80E. 80E for education loan. If you have taken education loan for higher education means after class 12th, if you want to pursue some higher education, be it in India or outside India also, if you want to go and pursue some education, for that if you would have taken any loan, in that case whatever interest payments you make, that is eligible for deduction under section 80E. There is no limit for amount of deduction which you can claim of interest. Mind you, only interest deduction is given. Principal deduction is not given under this section. It is available in the case of a individual. How much is the qualifying? What is the payments qualifying, sir? Even pursued in India or abroad. Education which is pursued in India or abroad is eligible. Interest on loan, there is no limit. Interest, the loan should be taken from financial institution or approved charitable institution. Sir, I took loan from my friend, sir, that is not eligible. Now, who is a relative is given here. Higher education means after class 12th, as I told you. Period of deduction is very, very important. For how many years I will get this deduction, sir? First, in the first year in which you took loan plus 7 years succeeding. So first year of interest payment plus succeeding previous years. First year of interest payment, it says. Let's say for example, I took loan this year, but I started paying the interest in the next year. In that case, that interest deduction I can claim from the next year plus 7 further years. The next section is 80EE. See, in order to boost the real estate sector in the country, income tax department or the Indian government comes up with these kind of deductions. If this kind of deductions are given to public, they will take more loan and buy more property, so real estate sector can keep moving on. Under 80EE, interest on loan borrowed for acquisition of residential house property by an individual. Means very simple, boss. You have to buy a house by taking loan. Only if you take loan, when only it is eligible, that whatever interest you will pay no on that loan, that interest amount is eligible for deduction here. If you are buying home from your own money, then there is no deduction. No, yes or no? Now, who is eligible? Individual who has taken loan for acquisition of residential house property. Residential house property, it is not available if you have taken a land. Getting it? From any financial institution, you have to take the loan from financial institution only. You cannot take it from your friends. There are some conditions attached to it. The stamp duty value of the property which you are purchasing, the stamp duty value should be less than or equal to 50 lakhs. Means the house should be worth less than 50 lakhs. You cannot go and buy a bungalow. Okay, 50 lakhs worth. The maximum loan of a sanctioned for this purpose is maximum 35 lakh rupees. So purchasing home worth of 50 lakhs and the maximum loan I should take is 35 lakh rupees. And there is one more condition. You should not own any residential house property at the time of buying this property. If you already own a house at the time of purchasing this property, then you cannot claim deduction on this interest. The loan should be sanctioned during 2016-17. So actually this section was introduced in 2016-17 so that they can boost the real estate sector in the country. So the period of benefit till the repayment of loan continues, you can claim the interest deduction. How much interest deduction I can claim, sir? Maximum 50,000 you can claim. Mind you, interest deduction for a house property, again we have under income from house property separately under section 24. Apart from that, this 50,000 is in addition to that. Next, 80EE. See, 80EE, the scheme was only during 16-17. Again, in order to boost the real estate sector, they came up again with a new scheme in 2019 to 2022. So, if you are purchasing a house between 1 April 2019 and 31st of March 2022, then also you can claim deduction under this if you are making payment of interest. But mind you, the same condition of not owning a house at the time of purchasing this property will apply here. Means at the time of purchasing the whole house under this section, you should not own any house. For whom this is applicable, sir? Individual who has taken loan for acquisition of residential house property. Same dialogue. SDV here is given is 45 lakhs. Their SDV given was what? 50 lakhs. Loan maximum of 35 lakhs. But here there is no limit of a loan maximum. Only SDV of the property should be up to 45 lakhs. The loan should be sanctioned between 1/4/2019 and 31st of March 2022. Should not own any residential house at the time and should not be eligible for claiming deduction under 80AA. Automatically you will not be eligible under 80EEA, because if you are already taking a deduction under 80EE, then it means that you already have a house property now. Then automatically you are not satisfying this condition. Yes or no? Next. till you make a repayment of loan, you can claim the interest deduction. The maximum interest deduction given here is 1,50,000. In the 80EE, the deduction given was only 50,000 rupees. This is again in addition to section 24 deduction. Next, double EB, 80 EEB. You can remember like this. EB means electric bike. You can just remember like this. Interest payable on loan taken for purchase of electric vehicle. So if you are purchasing any electric vehicle, and if you make payment of interest, and if you take electric vehicle on a loan, if you have purchased the electric vehicle on loan, and on that loan if you are making any interest payment, that interest payment is eligible for deduction, maximum 1,50,000. When should you purchase? Between 1/4/2019 and 31st March 2023. In order to boost the go greener in the country, means all the petrol vehicles should be vanished and only the electric vehicles should run. That is why this kind of schemes are run by the government. You should take loan from the financial institutions. For an electric vehicle, you should take loan. Now comes 80G. So if you make any donation to these specified institutions, in that case you get deduction. Lot of times you see, generally it is seen that you go to some temple or charitable institution, you make donation, then you ask them, so is it eligible for 80G deduction, sir? Then we'll tell, yes, we are registered under 12AA, so you will get that registered, you will get the deduction under section 80G. That 80G deduction we are talking about. So whenever you go temple, whenever you give donation, you ask them, sir, is it eligible for 80G deduction or not? Are you getting it? Now, so under 80G deduction, there are 4 categories, boss. Firstly, 2 major categories, then 2 minor categories. What are two major categories? Unlimited deductions and limited deductions. Unlimited category and limited category. Under unlimited category also there are two minors. 50% unlimited, 100% unlimited. Limited also there is 100% limited and 50% limited category. What is this, sir? Simple, boss. Unlimited category, no. How much ever you donate, out of that, if it is a 100% category, 100% of unlimited amount you can claim deduction. Let's say for example, I am donating 50 crore rupees to a 100% category. In that case, full 50 crores I can claim it as a deduction under chapter 6A. Let's say for example, I am contributing, I'm donating, but I am donating to a 50% category, unlimited category donation. In that case, let's say for example, I donated 50 crores. In that, 50% only will be claimed as deduction, which is 25 crores. Unlimited means 100 crores also if I deposit, if I donate under 50% category, then 100 crores, 50% is how much? 50 crores. So there is no limit, 1000 crores I can donate. But in limited category, there is a limit on how much amount you can donate. Are you getting this? Let's look at these things in a detailed manner. So this is applicable, very important. This is applicable for all SSCs, boss, even companies, individual, HUF, anyone. It is applicable for everyone. So as I told you already, there is an unlimited category, unlimited and limited category. Under unlimited category, again, you have 100% and 50%. Under unlimited category, you again have 100% and 50% of unlimited category. What are these eligible donations? Let's have a look. Under 100% unlimited category, national fund. So wherever you will see national, prime minister, chief minister, see here national, prime minister, Africa contribution, PM cares fund, again prime minister fund, national children's fund, under army central fund, chief minister fund. You have to just remember these things so that it is easy for you to recall in examination and apply. So Swachh Bharat Kosh, Clean Ganga Fund, PM Cares Fund, all these funds are eligible for 100% unlimited deduction. There is only one deduction which is available under 50% unlimited category, which is PM Drought Relief Fund. PM Drought Relief Fund. If you are donating to PM Drought Relief Fund, in that case, unlimited amount you can donate, but 50% of whatever donation you made will only be eligible for deduction. Then we have a limited category. Boss, limited category means you have they will cap or they will fix a amount up to which only you can make a donation. Out of that, they will take 100% and 50%. Let's have a look at this. In this, there are two categories again, as I told you, 50% and 100%. Under 100%, only two things are covered. If you are donating for a promotion of a family planning to some government or a approved local authority or any other institutions, or donation by a company, if you are donating, that is not eligible. Only donation made by a company to for the development of an Indian Olympic Association, for a development of sports or games, or sponsorship of sports or games, only these two are eligible for 100% limited category deduction. Whereas if you are making donation to public charitable trust, housing development authority, for renovation or repair of any temple, gurdwara or mosque, or a donation for promoting minority community, in these four cases 50% limited category will be applicable. Let's look at what is this limited category, sir. How to compute unlimited category? Very easy. Whatever donation I will make, if it is 100% limited, 100% category, unlimited total amount I can claim deduction. But in the case of limited category, I should know what is the limit prescribed. Now, method of computation of eligible donation under limited category. We are looking at the eligible donation which is eligible under limited category. So you have to compare two things. Whichever is lower will become your eligible deduction or a donation. 10% of adjusted total income and total actual donation under limited category which you made. When they say total actual donation, you will add both the 100% eligible deduction and 50% of a limited category donation. I repeat, when they say actual donation under limited category, you will add both 100% donation you made and 50% donation under limited category, whatever you made, you will take these two and compare it with 10% of adjusted total income. Now, your question is, sir, what is adjusted total income? Very simple. Take the gross total income, but don't include 112A and 111A. Reduce all chapter 6A deductions except 80G. What you arrive at is adjusted total income. Take 10% of adjusted total income here. Take the total limited category donations you made, means total of only these two donations. What you made actually. Don't take these two again. Okay. Only you have to consider what? Only you have to consider these two in these two categories. Whatever actual donations you made, you will consider and compare it with 10% of adjusted total income. Then you will arrive at that eligible donation under limited category. Are you getting this? Next, these donations should not be made in cash. Only maximum 2000 you can make in cash. Beyond 2000 you should definitely make in the prescribed modes or other than cash modes. Donation in kind is not eligible for deduction. Next one is 80GG. See, if you are an employed person, means you are an employee in an organization, you generally receive what? House rent allowance you receive. If you are residing in a rented house property, yes or no, you receive what? House rent allowance. But for a non-employee, let's say for example, I'm a self-employed. I'm not an employee in any organization. In those cases, this section will be applicable. 80GG, rent paid for residential house property. This is not applicable. This section deduction you cannot claim if you are receiving house rent allowance. You being an employee, you are an employee, but you did not receive any HRA from your employer, then also you can claim here. Okay. This is he who has not received HRA and pays rent of a house. He can claim deduction. How much deduction, sir? Condition for availing deduction, the same dialogue. You should not own any house property. Quantum of deduction is very simple. You will compare three things. Whichever is lower will be your deduction. 5000 per month, actual rent paid minus 10% of adjusted total income and 25% of adjusted total income. What is adjusted total income, sir? Gross total income minus all deductions under chapter 6A except 80GG. See, wherever adjusted total income comes, no, generally you will see the same dialogue. Adjusted total income means first you take a GTI minus all deductions except the deduction for which you are computing the deduction for. It is like that only. Next, 80GGA, donation for scientific research and rural development. If you remember in PGPP, there is one section, section 35. There also you make donations to scientific research. That is why here it says if you are if you are a PGBP person, then this deduction is not eligible. Means if you are doing business, then you cannot claim deduction under this section. All assessee except assessee having income under PGPP head. How much the deduction, sir? 100% is allowed. Maximum 2000 you can make in cash. Other payment you have to make in other than cash modes. Then 80 GGB donation to political parties, 80 GGC donation to political parties. See, GGB is applicable in the case of companies. GGC is applicable for person other than company. If you make donation to any political party, full 100% is allowed, boss. But the only condition is you should not make a donation in other than you should not make donation in the form of cash. Maximum 2000 is allowed in cash. Now comes very important section, which is 80 double JAA. See, in order to increase employment in the country, to promote employment in country, to remove the unemployment, to remove the unemployment in the country, this kind of schemes the income tax department gets. What is this scheme? You know, this scheme 80 double JAA deduction is applicable only in case of a new entity which is creating employment or generating employment. If any entity generates employment, in that case, whatever payment or remuneration paid to the employees, on that amount 30% is eligible for deduction for this person who is creating this employment. Are you getting this? Let's have a look. SSC should be engaged in business. Of course, if you are in business, then only you will employ people, no? Mandatory to get books of accounts audited, boss. Business should not be formed by splitting up. I told you it should be a brand new business. How many years you will get deduction? You will get deduction for 3 years. So for 3 years, whatever new employment you generated in your business, for all these new employment, whatever money you pay to them no as a salaries, of that salary expenditure, another 30% extra you will get as deduction. Business is not acquired. Return of income is filed within due date. These are the conditions. Then how much of amount of deduction, sir? 30% of additional employee cost. Now, what is additional employee cost, sir? Let's say, for example, this is the first year you started your business. You employed 100 people. In the first year, you employed 100 people. So all 100 is new employees only, no, because you started business in this year only. So all 100 are new employed, yes or no? So all these are additional employees, yes or no? Because at the year start it was 0. So you employed or you hired 100 people or 100 are new. So all 100 are eligible for generally eligible. Let's say for example they satisfy all the other conditions given. Then all 100 are eligible, yes or no? In the next year, let's say for example, out of 100, 40 left the organization. They left your organization and you joined another 40 people. Then you cannot say, sir, in the second year I generated 40 more employees. No, because overall the number is same only. No, out of 100, 40 went off, 40 came. Then where is the new employment generated? Nothing. So let's say, for example, in this example, out of 40, 40 left, but let's say, for example, 40 left, but came 60. 40 left the organization, new employees joined were 60. In that case, in the second year, how many employment you newly generated? 20 employees you generated. For them, whatever you pay emoluments, on that 30% will be eligible. Like this, you need to do for 3 years from the date you commence your business. Are you getting this? Now, 30% of additional employee cost deduction available for 3 consecutive years from the year of commencement. I hope that's clear. Now, what is additional employee cost, sir? Additional employee cost, because 30% of additional employee cost is eligible. No, what is additional employee cost? Total emoluments paid or payable to additional employees only, which I just now took example. In case of existing business, that is in second or third year, additional employee cost shall be nil if there is no increase in total number of employees. Whatever example I just now discussed. Emolument should be paid by account pay check, I means in the prescribed modes only. And I have given a beautiful example. Whatever example we have discussed just now, the similar example is given. You can read. In case of new business, emoluments paid to employees employed during the year shall be eligible. Of course, in case of a new business, in the first year, whatever employment you generate, fully it is eligible. No, because all employees are new only. Next, additional employees shall not include. You employed 100 people in the first year, but there may be a scenario out of these 100, there may be few employees who are ineligible. Why? Because they are not satisfying these conditions. If any new employee falls under this category, then he is not eligible, or whatever amount paid to him is not eligible for additional employee cost 30% deduction. Are you getting this? Who are these employees, or whoever is employee is falling under this category, that employee will not be treated as a new employee, though he is hired newly. But if he falls under this category, in that case, he is not treated as a new employee. What are these categories, sir? Employees whose emoluments is more than 25,000 per month. If the employee's salary is more than 25,000 per month, or whatever amount which is paid by the employer to this employee, new employee, if it is more than 25,000 per month, that employee cannot be treated as new employee. If the new employee stayed for less than 242 days only during the previous year, means within 240 days, 240 days, he left the employment, even in that case, that person is not treated as is not considered as new employee. If the employer is in the manufacture of apparel or footwear, in that case, if the employee leaves the employment within 150 days, less than 150 days, in that case, that employee is not a new employee. If the employee do not participate in the recognized provident fund, even that employee is not a new employee. If employee for whom the entire contribution is paid by government in the national pension scheme, in that case also, that employee will not be treated as new employee. So four things I told you. Number one, if the emoluments paid to the employee is more than 25,000, he is not considered as a new employee. If the employee left the organization within 240 days in the previous year, in that case, he is not treated as a new employee. If the employer is in the manufacturing business, in that manufacturing of apparel or footwear business, in that case, or leather products, in that case, if the employee left the organization within 150 days, that employee is also not treated as new employee. If the employee does not participate in the recognized provident fund, he is not treated as a new employee. And if entire contribution for the employee is for the pension scheme, if the contribution is made by the government, he is also not treated as new employee. Rest employees, if they do not fall under this category, and if he is a newly employed person, additionally employed person, in that case, whatever amounts paid to them, 30% of that can be claimed by your employer. Next, 80QQB. This is the income based deduction. Whatever we have seen from 80C to 80JJAA, all are expenses. You have to deposit here, you have to spend that money. It was relating to that. Now what we are looking at is deduction in respect of certain incomes. 80QQB is the first income. Income of royalty on books. Let's say, for example, you wrote a beautiful novel. Now you have to sell it off. Now there are royalty payments which you receive generally in the case of books and novels. And if you receive any kind of a royalty, in that case, it is eligible only in the case of a resident individual. How much of deduction I can get, sir? So you wrote a novel, you got royalty amount. In that case, out of that royalty income, how much you can claim deduction is given here. See, in royalty on books, there are two categories, boss. One, you can get lump sum consideration. Lump sum royalty means one bulk amount they will give you. How much ever they sell outside, it is their profit. There is a second category. Depending on the number of books sold, you will keep on getting the royalty. So if you receive lump sum royalty, then actual amount received will become your eligible royalty. But if you receive other than a lump sum amount, in that case, maximum 15% of value of books sold will be eligible royalty received. Why are we looking at the eligible royalty? Because to order to get the deduction, you have to compare two things. One, eligible royalty received. and maximum 3 lakhs, whichever is lower. So in order to compute this eligible royalty, if it is a lump sum, you will take actual amount received. If it is other than lump sum, maximum 15% of the books sold will be taken. Now you have to keep in mind one point. If you have sold books outside India, or if you are receiving a royalty from outside India, then you will be eligible to claim deduction only if you have got that money from outside India to within India within 6 months from the end of the financial year or the previous year. For claiming deduction of royalty earned outside India, such income must be brought into India into convertible foreign exchange within 6 months from the end of a previous year, in which within 6 months from the end of previous year, or within time allowed by RBI. Otherwise, the deduction is not allowed. Exactly the concept of 80QQB, there is a concept of 80RRB, deduction in respect of royalty on patent. Patent means what? You created some beautiful formula to create a product, that is called a patent. Okay. Resident individual, it is available for lower of royalty received and maximum 3 lakhs. The same dialogue of within 6 months, it is available here also. Next comes 80TTA. Let's say, for example, you have a savings bank account with a bank. Then whatever amount balance is there in your savings bank account, on that the bank will pay you interest. No, that interest, to the extent of 10,000, it is eligible for deduction. 80TTB is applicable only in the case of senior citizens. If they deposit any kind of amount with the bank, and if the bank gives interest to the senior citizen up to income of 50,000 as interest, is eligible for deduction, maximum 50,000. Now, there is a concept called SEZ, deduction under section 10AA. Deduction under section 10AA. First of all, what is the SEZ? See, special economic zone is a zone where lot of manufacturing entities or lot of service providing entities are established. They only do exports. Very limited they do domestic sale, boss. Maximum it is for export purpose only. Why export so much of boosting? Because more exports means more foreign exchange for the country. Are you getting this? Now, in order to boost this kind of entities, this deduction of a 10AA is given by the Indian government. What is it, sir? Very simple, boss. If you establish an entity in a SEZ either for manufacturing a product or for provision of any kind of services, in that case, for first 5 years, profit, export profit, whatever export profit you have, full 100% of the export profit is given as deduction. For next 5 years, means 6th year to 10th year, 50% of the export profit is given as a full deduction. 50% of the full export profit is given as deduction. For the next for the next 5 years, means from the 11th year to 15th year, you have to compare two things. How much amount you have allocated to SEZ reinvestment allowance reserve, and 50% of export profits, whichever is lower is eligible for deduction. Are you getting this? Are you getting this? Let's look at this. Eligible assessee engaged in the manufacturing of a product or provision of a service in SEZ only. SEZ unit received approval up to 31st of March 2020 and started its operation before 31st of March 2021. So this timeline you have to keep in mind. So you have got approval by 31st of March 2020 maximum, but you are given one more year extra to start the operations, that is up to 31st March 2021. Plant and machinery in the SEZ business shall be brand new, boss. Maximum 20% can be second hand. Plant and machinery imported will be treated as new. Are you getting this? 44AB tax audit is very mandatory and return should be filed within the due date prescribed. How much of deduction, sir? Just now I explained you 100% in the first 5 years, 100% of export profit. In the next 5 years, 50% of export profits. In the next 5 years, lower of these two things will be given. What is export profit, sir? Export profit means total profit into export turnover by total turnover. Very logical, Noda. Total profit of SEZ you take, multiply by export turnover divided by total turnover. Sir, my total turnover, export turnover, sir, then your total profit, export profit. Come on. Next, Export profit means that proceeds of exports brought into India and convertible foreign exchange within 6 months. So in royalty also you have to bring back that amount which you are receivable amounts whatever are there in the from the foreign country, you have to receive within 6 months from the end of the previous years. There are few important points. Let's have a look at them relating to 10AA only. S is that reinvestment reserve, whatever you are creating. No, here S is that reinvestment allowance reserve. This should be utilized within 3 years for purchase of a new plant and machinery. Shall be utilized for acquiring new plant and machinery and shall be put to use within 3 years from the end of a previous year. Now, let's say for example, this dialogue, what is there? No, within 6 months you have to bring back the money from foreign. If money is not brought back to India, but there is one separate account created in outside India and amount is deposited there with the approval of RBI, then it will be deemed that you have got that money and you will get this deduction. If the amount of realized export turnover has been credited to a separate account maintained by assessee outside India with the approval of RBI, the sale proceeds are deemed to have been received in India. Now, what does this total turnover and export turnover include, sir? Total turnover shall not include freight, telecommunication charges, insurance, expense for providing services outside India. Are you getting this? So total turnover, whenever you will take for this formula, you will not include these items given here. And the total turnover shall also not include any cash compensatory support, duty drawbacks, profit on sale of import entitlement license, or any ancillary profits of business. Total turnover includes export turnover, domestic turnover, further includes even that portion of export turnover which has not been received in a convertible exchange. Are you getting it? Next. Deduction shall be claimed after claiming deductions. All chapter 6 deductions and gross total income. From gross total income, after claiming all chapter 6 deduction, you will claim 10AA deduction. Is it clear? Next, the last concept is alternate minimum tax. See, alternate minimum tax is applicable in case of all assessees except companies, boss. It is applicable in case of all companies. Number one. Okay, except company, all assessees it is applicable. Number one condition. Number two, alternate minimum tax is not applicable under default tax regime. It is only applicable under optional tax regime. Getting it? So all assessees except company and under the default tax regime it is not applicable. Are you getting this? I'm sorry, here only it is written. Only under optional tax regime this is applicable. The third condition, this alternate minimum tax is applicable only if you are claiming deduction under 10AA, 35AD, 80JJAA, QQB and 80RRB. I repeat, this 8 alternate minimum tax concept is applicable only if you are claiming deductions under 80JJAA, 35AD, 10AA, 80QQB and 80RRB. Only if you claim these deductions, then only you will apply AMT concept. Now, what is AMT, sir? You have to compare two kind of taxes. Number one, income tax payable as per normal provisions of Act and 18% of adjusted total income. This 18.5% is the AMT tax rate. Alternate minimum tax rate is 18.5%. On what you will apply is adjusted total income. Again, here also adjusted total income we have to compute separately. Are you getting this? So what you compare is two things. Number one, tax as per the normal tax rates and 18.5% of the adjusted total income. Why are we doing this thing? Why are we doing this? Because see boss, whenever you claim these deductions, 80JJAA, 35AD and all, almost because of this you will be paying very less taxes. In order to ensure that you have to pay minimum this much of tax, this alternate minimum tax is paid. Only if you are claiming, see, 35AD and all huge capital expenditure you will spend, and if you claim that as expenditure, your profit will drastically come down. You will hardly pay any tax to the government. So, in order to ensure that at least this much tax has to be paid by the assessee, in order to ensure that the government says, boss, I will apply a concept of alternate minimum tax and I will check at least you are paying this much of tax. So you will compare these two. Of course, whichever is higher will be paid as a I mean, will be called as the alternate minimum tax. Now, what is adjusted total income, sir? Total income as per the normal provisions of the act you will take after claiming all the deductions and all. Total income means what? GTI minus chapter 60 deductions. That is what is called as total income. That you will take. Then you will add back whatever deductions you took already under chapter 6A. 10AA, 35AD, 80JJAA, 80QQB, 80RRB. All these deductions again you will add back. Now logically think, 35 AD, if you remember that section, in 35 AD it is clearly mentioned. If you are claiming 100% deduction under 35 AD, then depreciation on the capital asset will not be allowed, it was written. Now, if 35 AD, if you disallowed, then I am now eligible for deduction for depreciation or not. That is why here, less depreciation under section 32, assuming deduction under section 35 AD is not allowed. Are you getting the logic why we are reducing depreciation here? So if you reduce that, you will arrive at something called as adjusted total income. That adjusted total income, on that you will compute 18.5%. You will compare it with the tax as per the normal provisions of act. Whichever is higher will become alternate minimum tax. Now let's say for example, whatever adjusted total income you computed is less than or equal to 20 lakh rupees, then you need not compute adjusted total income or alternate minimum tax. I repeat, if the adjusted total income whatever you computed here, if it is up to 20 lakh rupees, then in that case you need not compute the alternate minimum tax, where it is given, sir, AMT not applicable if adjusted total income is up to 20 lakhs in the case of individual, HAF, AOP, BOI, AJP, etc. Are you getting this point? Are you getting this point? Yes or no? Next, what how AMT works? Let's say for example, this year, as per the normal provisions of the act, I am liable to pay tax of normal provisions of the act. I am liable to pay tax of 10,000 for example. When I computed the alternate minimum tax by following all the procedure which we just now discussed, let's say for example, I am arriving at a 13,000 tax payable. Now, normally I am required to pay 10,000, but my alternate minimum tax is you have to pay 13,000. Then what tax I will pay? Of course, higher of these two, no, I will pay, which is 13,000 I have to pay. So if I pay 13,000, how much excess I am paying? 3,000 I am paying. No, 10,000 minus 13,000. 3,000 will be called as AMT credit, alternate minimum tax credit. This credit I can carry forward to the next years, and I can set off in such year when I am paying a tax of normal tax more than the alternate minimum tax. Are you getting this? I repeat, whatever excess I paid this 3,000, I can carry forward to the future years, and I can set off this 3,000 in the year in which my normal tax will be more than my alternate minimum tax. That's what is given here. If alternate minimum tax is more than the normal tax, then excess shall be treated as AMT credit. AMT credit can be carried forward and set off for 15 years. I can carry forward, boss. Credit can be set off in the year in which regular tax is more than alternate minimum. Is it absolutely clear? Okay, guys, let's wrap the session of deductions from gross total income.